Good morning, everyone. Welcome to this meeting of the Shadow Open Market Committee. We are delighted to have you with us, whether you're here in person or whether you're joining us virtually. We're delighted that you can join us today. I also want to thank Manhattan Institute for supporting us and helping us put this event on. They've been very helpful, and I want to express my appreciation for them. I also want to especially welcome our guest speaker at lunch, which is Loretta Mester. Loretta is president, as you all know, of the Federal Reserve Bank of Cleveland, and we are delighted to have her joining us once again. As most of you know, Loretta and I worked pretty closely together for about over 8 years when I was president of the Federal Reserve Bank of Philadelphia. So I'm always delighted to have her back with us, and I want to welcome her, and I'm sure she'll have some interesting remarks. The theme for our discussion today is entitled "Have We Dodged the Bullets?" And I think it's going to be an interesting morning for us. There's a lot of sentiment out there that the Fed has achieved its goal for inflation, or at least it's well on its way to that, and that we've averted a banking crisis that arose earlier this year with SVB and the failure of several banks. Those issues arise in the context of the Fed, both from the standpoint of appropriate financial stability issues, as well as the conduct of monetary policy and inflation. So we're going to talk about both of those today. We're going to start with a discussion about financial stability and regulation and ask questions about how did the banking crisis of 2023 play out? What did we learn from that? And can we be optimistic that the challenges or volatility that may stem from that episode are now under control? And we'll look forward to maybe what's the right way to manage financial stability and what lessons might have been learned. And we have some observations about that we'll talk about. The other topic, of course, for monetary policy is inflation. Inflation has been well over target for almost 3 years now, rising as high as over 4 times the target of 2% that the Fed has announced. And it's still about twice the target, maybe somewhere just below 4%. Is the Fed's work done? Has it been successful in restraining inflation? There are people on both sides of that argument. Some say yes, some say, well, maybe not. The battle's not won yet, although the recent data is looking good. So there are lots of consequences and discussion about what the status of policy should be at this point and what it looks like going forward. And that's going to be the second topic of our discussion this morning. So I want to take this opportunity once again to welcome everybody. I think we'll have an interesting discussion. And thank all of you for being here, as well as Manhattan Institute for their support. So welcome. Thank you for coming. And I'll turn it over to Jeff now, who is going to lead the panel for the first discussion. Thank you.
Thank you, Charles. Thank you all for attending, joining us here today. Thank you again to the Manhattan Institute for hosting us here. The first subject, as Charlie Plosser indicated, is banking. Earlier this year, the U.S. experienced another in a long series of banking crises. Analysts toiled for days, weeks, months to try and divine the implications for various facets of economic activity. One implication was clear: the precedent set by the rescues of those institutions back then and the communications about the prospects for future rescues. Again, as with many other instances of banking crises in the U.S., expanded the set of precedents that people rely on to divine whether an institution is covered or not covered by the federal financial safety net. But another implication of the banking crisis, in this case for intellectual activity, I think is a prediction that one would have had virtually full confidence in, 100% confidence, and that is that the incidents would give rise to intense scrutiny of the regulatory and supervisory regime under which those banks operated. So we're going to add to that scrutiny here today. Luckily, on the Shadow Open Market Committee, we have two absolutely superb world-class experts in banking and financial regulation. We have more than two, but these are our best, our players on our team that will trot out for this. And I'm going to start with Charlie Calomiris and Deborah Lucas. I'm going to start with Charlie Calomiris. He is a member of the Shadow Open Market Committee, as I indicated. He has a distinguished record of research on banking and finance, particularly banking history. He served for many years as the Henry Kaufman Professor of Financial Institutions at Columbia Business School and a professor at Columbia School of International and Public Affairs. He's recently completed a term as director of the Center for Politics, Economics, and History at the University of Austin. He's a research associate at the National Bureau of Economic Research, and he's the author of the 2014 book with Stephen Haber, Fragile by Design, The Political Origins of Banking Panics and Scarce Credit. And I couldn't recommend that highly enough. It is the book you should go to understand at a more foundational level what's going on with banking regulations in the United States. So, Charles?
Jeff, thanks so much for that very generous introduction. Welcome to everyone. It's a pleasure to talk to you today. And I want to start by thanking my colleague, Mickey Levy, because last night we had a wonderful dinner. And when I was reviewing some of the things I was going to be saying today, Mickey said, well, I know what the title of your talk is. And he was right. The title of my talk, well, I'll give it to you as a sentence, is the recent banking problems and the policy responses to them are really a window into something particular, which is all of the costs that we bear when we don't have a systematic approach that's systematic and effective, and I would say principled, in bank regulation, bank supervision, and safety net policies. And so what I'm going to do is I'm not going to spend a lot of time reviewing all the facts, but I'm going to go through the facts of the crisis and then the policy response to it. But at the end, I'm going to point out, and along the way, but especially at the end, what a systematic approach would have done differently, so that we can think about the same lesson that this committee has really been involved in articulating for 50 years about how the monetary policy problems in the United States are not just one-off errors of judgment of a discretionary program from moment to moment, but they reflect rather the absence of something crucial, which is a systematic framework that takes good thinking and applies it in a way that it provides discipline to thinking over time so that you get a better outcome. That is the problem, not just with monetary policy, but with all of our policy framework in money and finance. But it's not an unsolvable problem. That's the theme of my remarks. Let me start by reviewing how we got what the sort of proximate causes of the problems were. So there were 4 banks that failed during the crisis, one that failed prior to March, the other 2 that failed in the midst of it, and then 1 later. All 4 banks had things in common. They had all tripled their asset size over the 2 years prior to their failure. And they were all, despite differences in their business plans, and which were dramatically different, they were all taking the same fundamental kind of risk, which was riding the yield curve in the asset classes that they were occupying. In other words, in finance, we call that carry trade banking. All of the banks were growing their portfolios extremely rapidly because their way of making money was not based on creating value through the traditional means of establishing relationships, which is what banks do. They were creating their profit by carry trade strategies, which can be done very quickly. we would also recognize that there's a lot of examples of this in the low interest rate environment since 2008, because people are looking for, it's called a search for yield process. They're looking for ways to get through taking on risks, quick increases in their profitability. You can do that in the foreign exchange market. You can do it by riding the yield curve. I won't go into all the examples of this, but there's a large literature that developed since 2008 all about the way that the low interest rate environment has encouraged carry trade kinds of strategies. So this is just an example of that. In that sense, the monetary policy environment was a key ingredient to it. It was a key ingredient to it in another way, and that is that it created, because of a lack of systematic predictability in the monetary policy process, that meant that you could be very confused as a banker about how the inflation that we were all seeing in, let's say, 2021, how it would be resolved in terms of interest rate increases. How much of an interest rate increase for how long would you need? Now, we not only didn't have anything like a Taylor rule or some version of that to guide us in our thinking about that, because the Fed doesn't have a systematic framework, doesn't even have a single interest rate target. Not only did we lack that, but people at the Treasury and at the Fed were telling us that inflation was transitory. So if you go back and look at the dot plots of the FOMC, of course, what you'll see is as of 2021, no one was projecting dot plots that look anything like the interest rate history that evolved. So you can now understand in retrospect why many banks would have decided, which had a lot of capital, which had a lot of enterprise value, would have decided that despite the existence of inflation, very high inflation, that there was nothing to worry about because interest rates weren't going to have to go up very much or for very long. And a lot of banks continued not only to take this bet, but they recognized some volatility that might come from this rise in interest rate environment. And so after 2021, you also see an increased use of so-called hold-to-maturity accounting by financial intermediaries to avoid having to recognize volatility in their actual performance based on the interest rate volatility they were about to experience. Here's the really sad thing. Once you've made that decision to use hold-to-maturity accounting, you can't get rid of it. You're locked in. So you've decided you're betting the store still on interest rates not going up very much. What happens if in spring of 2022 you decide, maybe that wasn't such a good bet, and by the way, you decide that increasingly? So you might say, well, I can lay off some of those treasuries. You can't. If you start selling them, you have to do an entire accounting restatement to recognize all the losses. The other thing you might think is you might take on a hedge, an interest rate risk hedge. It would be a normal thing to do, except if you do that, you've undermined the legitimacy of your accounting practice of pretending you were already hedged in the first place, which means you'd have to do an accounting restatement. So the banks were locked in, which is why through 2022, they continued to maintain their positions. Now, of course, they would have been better off just selling some of the securities, taking on some of that hedge in the spring and summer of 2022, and they would have been better off, but they never really believed that. And if you go back and look at the dot plots, they weren't alone. The policymakers were telling them it would all blow over. SVB, for example, was experiencing about $20 billion of deposit runoff in the spring and summer of 2022 as a result of the problems that they were facing in lost value. Let me remind you that the 10Ks of SVB reported, alongside the phony numbers coming from hold-to-maturity accounting, reported the true numbers of the losses. When they experienced that loss in the spring and summer of 2022, what happened? If they had been operating under normal banking practice, they would have engaged in a disciplined correction. They would have sold off some securities, they would have taken on some hedges, they would have done an accounting restatement, raised some new equity, and they'd still be here. Instead, the Federal Home Loan Bank lent them the 20-some billion that they'd lost in deposits as a result of the private market's reaction to their weakened condition. Wasn't that helpful? So that safety net policy actually discouraged and prevented any kind of adaptation. And then things, of course, just kept getting worse. So the combination of accounting practices in financial regulation, hold-to-maturity accounting, low interest rate environment confusing monetary policy framework and inappropriate safety net policies by our competing lender of last resort, the Federal Home Loan Bank, certainly made what was already a difficult situation much worse. What about the supervisory and regulatory responses to the crisis? I think one thing I want to give the Fed officials credit for is both Michael Barr and also Mickey Bowman have made statements that have recognized the deficiency of the supervisory response. But I want to emphasize that the deficiency of the supervisory response is not a one-off because there were bad people or because there were ineffective individual perceptions or hidden information. It was none of those. In fact, this problem of ineffective supervisory response is a systematic problem that we've seen for the past 40 years, and it reflects agency problems within supervision. I was, for a brief period, for 1 year, the chief economist and senior deputy comptroller of the OCC. So I learned a lot about examination and supervision, and I have to say, with all respect to my colleagues and to that institution, what I learned was not very good. Supervision tends to follow a kind of check-the-box approach. The nickname for the manual, the examination manual at the OCC is the brown rat. That's leather bound in this brown leather. And it's all about taking undergrads who didn't get their CPAs, making them examiners and giving them a bunch of boxes to check about what the health of a financial institution is. And that's how the process works. Economic thinking is absent. I don't say underweighted, absent in that process of examination supervision. So what are the problems? Well, given that you're not measuring things that are relevant on an ongoing basis, I want to emphasize you have access to it. You know that SVB lost the capital. It was in their 10K. You're doing an examination. Part of the examination is you know what the interest rate risk exposure of a bank is. It's calculated by the examiner. You know these things. You just don't do anything about them. Well, you might send letters to the bank saying, hey, we're kind of worried. You're losing all your capital. Everything's gone. But you don't have, first of all, a precise measure of a summary measure of what the problem is. In finance, what would that measure be? It's called the distance to default. We have multiple approaches. By the way, I introduced into the research department at the OCC projects for measuring distance to default of banks, a single statistic computed 3 different ways, which could be used on the supervisory dashboard of examiners so that supervisors would have a single set of measures that they would see on a continuing basis that would tell them what is the bank's distance to default. And then what you need on top of that. So first you need to have something measured that you're reacting to. And secondly, you need to have, because of the politicized incentives to act as a supervisor, always are weighing in the direction of delay. You need to have preset timelines for acting based on those facts. That when the distance to default gets very small, you must act within a time frame or explain. The burden is on you to explain why you're not acting. All of that is missing. And so without that systematic framework, supervision will always be guided by check-the-box thinking without any underlying framework and by a complete absence of incentives to act on a timely basis. It's not about bad individuals. It's about a system that allows completely incompetent examination supervision practices. That is what we're living with for 40 years. It's never been addressed, and it's easy to fix. That's the sad thing. Okay, what about regulation? So regulation, of course, also has started, going back again about 40 years, started with the wrong idea. The key wrong idea was that banks are balance sheets determined in their value by some accounting practice. Banks are not balance sheets. Banks are service companies. Can you imagine trying to understand the health of Microsoft by looking at its tangible assets? By looking at its balance sheet construct of tangible assets? That would be silly. We'd all laugh. Banks are service companies. They're not just balance sheets. They don't just have tangible assets. Now, what's the problem in the way we're measuring the value of a bank and its safety and soundness? We're assuming that they only have tangible assets. And of course, then we have this regulatory accounting treatment with hold to maturity accounting, which mismeasures the value of the tangible assets. But in fact, the problem is not just the hold to maturity accounting. That's part of it. But the bigger problem is banks have cash flows unrelated to their tangible assets. In fact, that's kind of a big part of what the health or lack of health of a bank is about. How do we know that how can we capture that? Well, you could look at the market value of the bank, and you could look at the ratio of the market value of equity to the market value of assets. If we had done that in 2008, the finance literature shows we would have detected the coming problem a year and a half before the crisis. We would have reacted to it. Citibank fails in December 2008. It still has, according to our regulatory measures, capital ratio of about 12%. According to market value measures, a year before, it had about 2%. So the point is, our regulatory measures are wrong. The finance literature has recommended, almost universally agreed upon by professors, if you can even imagine that it would be good to use a variety of measures to bring market information, not just into the supervisory dashboard, as I described, but into the actual regulatory measures that we hold banks accountable for, that would either use market values directly in the computing of the regulatory minimum capital ratio, or incentivize managers through contingent capital devices. And I don't want to get into that right now because I know that I have limited time, but I would love to talk more about that. And also embed similar kind of thinking into the structure of bank manager compensation. Let me move on. Safety nets. So safety nets, as you know, the response to the crisis was two different kinds of safety net responses. One was for the Fed to make, with no haircut at that same phony mark-to-market, non-mark-to-market number, a fully 100% loan with no haircut against those assets for up to a year on concessional interest rates. Now, let me remind you that in the 1980s, Fed lending to distressed banks or undercapitalized banks had increased their losses. Why? In finance theory, we call that the debt overhang or asset substitution problem. It was first formalized in the 1970s, which basically means if somebody's in trouble financially, the last thing you want to do is just give them another loan, because it makes them purposely take on riskier kinds of behavior. That lesson was taken very seriously from the 1980s and was reflected in FIDCIA's 1991 prohibition on discount window lending to weakened banks. So how come we did it? Well, we did it because there's a systemic risk exemption to that rule that says, well, we're really, really worried, we just do bad things anyway. So that's how the Fed was able to justify that. And then the other thing, of course, was that the Treasury championed this 100% guaranteed for uninsured deposits at SVB and Signature. I want to emphasize this had no systemic consequence. In fact, deposits continued to flow away from small and medium-sized banks to large banks after that bailout of those uninsured depositors. And furthermore, First Republic failed after that. So if you thought, oh, thank God the Treasury did this, no, it wasn't. It had no effect on the liabilities of other banks. It didn't protect them. And furthermore, didn't really solve a problem. What problem did it solve? Well, you might say, well, we were worried about the locking up of payment system because of the clients of SVB and Signature not being able to get access to their money. Au contraire. If the FDIC knew that those deposits were worth, let's say, at least 80 cents on the dollar, I would say at least 90 cents on the dollar, they could have given immediate access to that percentage of the funding of the checking accounts of the clients, and then waited for them to get the balance of their money after the resolution was complete. But they didn't do that. Why? What is the economic justification for bailing out those depositors, given that there was no systemic benefit from doing it? Well, the only thing I can think of is the political influence of those people in getting protected. That's a sad comment for me to make about our Secretary of the Treasury and our Fed officials. However, that is what I believe. I don't have any smoking gun. I just can't come up with a better explanation. I'm giving them the benefit of the doubt that they're not just plain stupid. Okay, what about the resolution of those banks? So we know that the FDIC held auctions. It's weird that in SVB and in Signature, money center banks didn't participate in those auctions at all. There are rumors that the FDIC basically prohibited them effectively from participating. I don't know if that's true. I'd like an explanation, though, of why they didn't participate. And by the way, there's a new ECB study showing that. Hold on to your chair, put your seatbelt on. The acquirers of SVB and Signature during the 6 business days of the auction and afterwards had what cumulative abnormal return to their acquirer stock value? 40% and 70%. The stock value of the acquirers went up by 40% or 70% as a result of the acquisitions. Does that sound like an efficient auction to you? There's so little transparency and so much reason to doubt that the FDIC is serious about pursuing its mandate of least cost resolution. Now, what should we have done in safety net policy? Well, what we should have done is something that Franklin Roosevelt taught us in 1933. The public knows that there are, according to Zhang et al., this 2 academic studies, there are 600 banks right now in the US that are tottering on the brink of insolvency as a result of interest rate exposures and commercial real estate exposures that are not being addressed through regulatory accounting or supervisory action. Their stock prices have remained depressed since March 2023 and have not recovered. Small and medium-sized banks in the US are a ticking time bomb. Delaying recognition of the problem, we know, is going to make the problem worse. What Franklin Roosevelt taught us in March 1933 is, what you do in that circumstance is you deal with the problem by examining the banks, forcing them to recapitalize. And then clearing up the problem. If we had done that, a lot of banks would have recapitalized, by the way, in 2022. A lot still could, but we have to force them to. Now, you might say, well, what if they can't recapitalize because they're too insolvent? They're not going to get the capital. Can we afford to have 600 banks shutting down? Well, again, what Roosevelt did in 1933 was he established something called the preferred stock program of the Reconstruction Finance Corporation, because the view was, rightly or wrongly, that there was too much of a systemic contraction of credit that would have resulted. And so the government subsidized recapitalization through a preferred stock program that was very successful. We did that in a less successful way, but still a successful way, in the TARP program in 2008. We could do that again now. We should have that framework in our back pocket, that if we make the decision that there is a systemic threat, instead of ignoring it because it's inconvenient to cause those banks to have to deal with their problem because it might cause a credit reduction, that we actually deal with it, get them onto a safe and sound basis. And if we need to use public policy, let's not lend to them, which is the worst thing to do. Let's actually help them to recapitalize. So I hope that I haven't gone over too much. I just want to illustrate that everything I'm telling you is based on financial research that has been done since the 1970s, in which there's widespread agreement among people who actually take on these questions, what I was systematically and logically. And the problem is the complete absence of that in our policy framework in monetary and financial economics. Thanks for your attention.
Thank you, Charles. Okay, can we bring up the image of Deborah Lucas? Can we do that? There she is, Deborah. Excellent. So our next speaker is Deborah Lucas, a member of the Shadow Open Market Committee. She has an extensive and distinguished record of research in financial economics, money and banking, and particularly public finance. She is the Sloan Distinguished Professor of Finance at the MIT Sloan School of Management and director of the MIT Golub, is that how you say it? Center for Finance and Policy. In the past, she served as chief economist and then as assistant director at the Congressional Budget Office in Washington, D.C., and as a senior staff economist at the Council for Economic Advisors, among other things. She's currently a research associate at the National Bureau of Economic Research. Please welcome Deborah Lucas. Deborah?
Great. Thank you very much. And I'm sorry I can't be there with you physically. I want to thank you, Jeff, for the introduction, and Charlie for just such a nice, broad, and deep overview of the issues. I wanted to go second because I want to hone down on a particular proposal that I've been working on with a co-author at Golding for a number of months now. It's something that's probably been on my mind for 20 or 30 years. So I was glad to finally get it down on paper. So I want to discuss a proposal, which is simply that banks should be required to disclose their duration gap, which I think would go a long way to preventing another SVB. So please turn to the next slide. Okay, so the background for this was very nicely set by Charlie, but the recent wave of bank failures seemed exotic to some people because SVB was dealing in all kinds of high-tech loans and all of that, but really it was an old story, which was the banks were riding the yield curve. They were borrowing short, lending long, and that created what's called a duration mismatch between their assets and their liabilities. So this is a gamble that not only banks take, you could argue the Federal Reserve is in some sense making the same gamble on behalf of the US public. But in any case, it's a gamble that's often profitable. But when it isn't, there are large losses and someone has to take the hit, either the bank's equity holders or ultimately the government when there's bailouts. So clearly we've seen this movie many, many times before. The S&L crisis in the 1980s was a classic case of this. The S&Ls were using deposits to fund long-term mortgages when rates went up. The value of those mortgages plummeted. The deposits more or less stayed the same in terms of value. So the hit was equity. They needed a bailout. I think something that people were maybe less tuned into that was going on at the same time is that a lot of mortgage volume was transferred from those S&Ls onto the GSEs, the government-sponsored enterprises, Fannie Mae and Freddie Mac. And at the time, Fannie Mae also had quite a large balance sheet with quite a large duration mismatch. They were basically holding these long-term mortgages and not using long-term liabilities. So Fannie Mae too was very close to bankruptcy. You might have argued, in fact, they were bankrupt, but regulators let them keep going and they managed to struggle through. So the movie we see is, okay, we have a large upward movement in interest rates. There's these big losses. We bail out some banks and other government-backed financial institutions. And then we see some kind of a regulatory response. Okay, so this time we saw a lot of hand-wringing and a beefing up of liquidity requirements. And I'm going to argue that the regulatory response was a bit bizarre because the issue here wasn't liquidity. I mean, certainly the banks wound up with liquidity problems once they were close to insolvency or insolvent, but the fundamental issue was solvency, not liquidity. So it was a kind of an orthogonal regulatory response. So the question is, we saw this movie, we saw it again and again and again, and not just in the US, but all over the world. So there's no doubt about the risk that's in our financial system when financial institutions ride the yield curve and there's nothing to stop them. So how did this happen in our highly regulated banking system? Was it fraud? Were the regulators asleep at the wheel? Were investors asleep at the wheel? It took quite a long time for these runs to really happen, but the increase in interest rates unfolded rather slowly over time. So actually, I might have asked, why didn't the investors run more quickly? But in any case, I don't think there was particularly evidence of fraud. I actually think the facts of the case were pretty straightforward. People have criticized the regulators a lot. And what I'll say about that is they might have not have acted as well as they could have, but there was no regulation that was really compelling them to act. I mean, what they did was within the rules, and they could have used discretion to act more quickly, but I think discretion is a slippery slope. And so what I'm going to be talking about here is how the rules could have been better. Next slide, please. Okay, so our premise is really simple. The problem is that given decades and decades and decades of problems arising because of interest rate risk, regulation has never squarely addressed interest rate risk. In fact, regulation is mostly directed at credit risk. If you think about risk-based capital requirements, just the basic structure is really focused on credit risk. But interestingly, credit risk has been, I think, relatively rarely the reason for these massive events. So it's rather weird that regulation hasn't addressed interest rate risk head on. And it's an even deeper mystery because the mechanism by which rate risk causes problems is completely well understood and it's highly quantifiable. You know, you can't say, oh, it would be just too hard to create a metric that will measure this risk. It's much, much harder to measure credit risk. So as I said a minute ago, just the last bullet point here is that the regulatory response that we saw recently to SVB and everyone else, again, skirted the issue of rate risk. Rather, it decided to treat the episode by focusing on the liquidity, that there would be runs by insured depositors. But I think that wasn't the main issue. It was an issue of interest rate risk. Next slide, please. Okay. So our proposal is, as I said, very simple. It's to require medium and large banks to periodically disclose what's called their duration gap. This is a single number that provides a very good measure of the change in the market equity of a bank as the result of interest rate changes. You might ask, why did we leave small banks out of this? I might have wanted to throw in the small banks too. So I'm not against the small banks reporting it. I think there is more systemic risk from this with the mid-sized and larger banks. So we had an eye to low regulatory burden. But the benefits of requiring banks to periodically report their duration gap in their financial statements is that it would provide truly new information to regulators and to the market about bank risk exposure to interest rate risk. It's cheap for banks to provide compared to the other kind of regulatory changes that are being contemplated. Banks already have the information to provide this statistic. And if they did provide the statistic, it would provide market discipline. And in a few minutes, I'm going to talk about the experience, the precedent of the GSEs providing this information and the change that it actually seems to have made in their behavior. So there is practical proof of concept, both that it's possible for financial institutions to easily calculate these statistics, and also that actually reporting them has a notable effect on the quality of their risk management. So next slide, please. Okay. You can go to sleep for a second. But when I talk about reporting a duration gap, for those of you who aren't steeped in Wall Street, that might sound like a non sequitur. So let me just take a moment to say what duration is and what it measures. Okay. So duration is a concept that's widely used in the financial markets. People understand it. It comes from basic bond math. I don't want to oversimplify too much because there's some subtlety that maybe some of you will ask about, which has to do with how do you measure the duration of deposits. But basically, duration is well understood. There's common methods to calculate it. What is it? Well, duration is an approximation for how much the value of any fixed income asset will change as a function of the change in interest rates. I never thought I would put calculus on an SOMC slide, but that one equation is very helpful. So duration is actually can be defined as being approximately the change in the value of a fixed income security for a small change in interest rates. If you turn that little equation around, you'll see that you can estimate the price change in the value of a security by just, if you know its duration, and you say, well, let's say yields go up by 3 percentage points, you can estimate how much the price of that security will change. Okay. And so you can estimate durations not only for fixed income securities, but also for derivatives that banks are using to manage their interest rate risks, most importantly for interest rate swaps. Okay. Okay. So what does duration really tell you? Well, as a first approximation, duration is related to maturity. So longer term assets, like mortgages, like treasury securities, have a relatively long duration. Short duration liabilities are deposits, short-term CDs, and so forth. So maturity is kind of a good proxy for duration, but it's not exactly the same thing, and you can do a lot better with duration. Okay, so what's the duration? Oops, back up. Okay, so the difference between, so if you want to look at the sensitivity of equity, the relevant concept is the duration gap, which is the difference between the duration of a bank's assets and the duration of the bank's liabilities. So think about the savings and loans. They had these very long duration assets in the form of these mortgages, and their liabilities were mostly deposits. So they had this duration gap, which was very large. And again, if you multiply that duration gap by the amount of equity, that if you take the duration gap and multiply it by the interest rate change, you get the change in equity when interest rates change. Okay, we're done with technical stuff. Go on to the next slide. Okay. So Ed and I looked at the information that SVB actually had disclosed or that was available in press releases, and we pieced together a kind of a rough estimate of what you might have known about their duration gap prior to their failure. And in fact, they had a stunningly large duration gap of maybe 3 to 4 years before insolvency. And by the way, duration, excuse me, often is expressed in units of time. So that's why I'm describing the duration gap as 3 to 4 years. So I won't bore you with the bloody details, but the fact is when you have a duration gap of 3 to 4 years and you look at SVB's assets and liabilities, we could estimate very simply, just one line of algebra, that a 1 percentage point increase in interest rates would have lost $6 to $8 billion of their gap equity, and a 2 percentage point increase in rates would have put them on the edge of insolvency. So we know what happened to rates, so there's no mystery of why the interest rate risk made them insolvent. Okay. Next slide, please. Okay, so you might think, well, we were able to kind of do this rough calculation, so can't people already do this rough calculation? Why put this additional burden on banks to do these disclosures? So I'll just mention two things very quickly. One is that if you look at the existing financial disclosures, it's true that you can kind of piece together a sense of the duration mismatch, but in fact, you don't have the detail of information to really do it properly. And it becomes ever more complicated for banks that are relying heavily on derivatives because the details of derivatives are really not disclosed in financial statements. I mean, that's a bigger problem in financial regulation, and it's very hard to see the effects of derivatives on the value of financial institutions. Something else I would say about requiring the reporting of this statistic is that if they disclosed it, it would be much more focal than when you can just infer it by looking through their financial statements. I mean, you know, analysts may already be taking it into account to some extent, but it would only become focal enough to influence behavior and regulators if it was actually reported. Now, in fact, Charlie alluded to the fact that regulators currently, another strange thing they don't do is they pay almost no attention to market equity price data in evaluating the solvency of banks. And I also find that perplexing and annoying. But I will say that on this issue of could we already have known what interest rate risk would do to banks, at least from the investigations we've done so far, the answer is market data on equity prices doesn't give you a lot of information about how interest rates affect bank equity. So it's kind of a weird scatter plot below. It's typical of what we found looking at these things. This is an example of Bank of America. And the simple question we asked is, if we look historically at how the value of their equity responded to recent changes in interest rates, do we see the negative relationship that we would expect if they were riding the yield curve? Okay, so equity would go down when interest rates went up. So you get this negative relationship between equity and interest rates. And that orange line is the regression line. We took out the small interest rate changes, which is why there's a gap in the middle. But what you can see is that orange line isn't very steep. So it may be not very steep because Bank of America wasn't doing a lot of riding the yield curve. But the bigger message I want you to take away from this is when you look at the response of equity to interest rate changes, at least without controlling for myriad other factors, you get very little signal about the effect from market data. So I think part of this is because market data is very forward-looking, and the interest rate risk is what's already on the balance sheet. And so the market data has all this noise in it that's just not relevant to the basic question: how much are their current assets and liabilities going to cause problems when interest rates change? So I think you do need the data in the financial reports, and I think you need to add the information about the gap. Next slide, please. Okay, so I mentioned that there's actually a precedent in what happened with the government-sponsored enterprises, or GSEs, Fannie Mae and Freddie Mac, from what happened back in the 80s. So as I mentioned, Fannie Mae was, by all reasonable measures, insolvent also in the 1980s for the same reasons as the S&Ls. There was regulatory forbearance, and they made it through. But despite that regulatory forbearance, there was also a lot of pressure on them to stop taking the kind of risk that they'd been taking. And the GSEs agreed that they would voluntarily disclose their duration gaps in their financial statements. In fact, they disclosed them essentially monthly. So they started doing that in the 80s. And since it was voluntary, kind of amazingly, they've continued to do that to this day. Now, in terms of an episode which proves that this was a valuable disclosure, it so happened that in October of 2000, there was this huge spike in the reported Fannie Mae duration gap. And the markets definitely took notice. If you look at a time series of their stock returns, of the spreads on their debt, and of their duration gap, you see that that spike immediately caused their stock price to fall significantly, and the spreads on their liabilities really widened. And as a result of that, the hedging practices of Fannie, and I think of Freddie, really changed. And we haven't had other episodes where they reported these big duration gaps. And in fact, Fannie and Freddie have been some of the largest users of the interest rate swap market, which is the way financial institutions like them would naturally manage that interest rate risk. So we did see a change in behavior. And the other thing I have on this slide, which is probably too microscopic for you to see it, is just the recent Fannie Mae report of their duration gap. And so what this is basically saying is, if we look, now this is just a snapshot of a number of months, and if we look over those months, we can see that their reported duration gap is very small. And they take that duration gap and they help investors further, and they say, well, look, with this amount of duration gap, this is how much our equity would change if interest rates went up by 50 basis points or something. So they're actually telling investors, this is the sensitivity, this is what it's going to do to our equity. So this is, this is great. It's not costly for them to be doing this reporting, and it's truly adding information they didn't already have. So next slide. Okay, so I think we could actually go a long way to preventing another crisis like the one we've had recently with just a simple change in regulation, that banks disclose the sensitivity to interest rate changes. The market would be able to help discipline the banks. It provides a signal to regulators, and we would have a safe banking system without an increase in two things, which is not much increase in regulatory burden, and also not the need to rely more on regulator discretion, because I think a lot of the proposals that have been made to try to address the situation have been to say, well, the regulators really need to be paying more attention. They need to change the stress test. They need to be more on top of the banks. But all of those elements that require discretion are problematic for various reasons that we can talk about. So I'll stop here, and thanks for this opportunity to present this proposal.
Thank you, Deborah. So we have ample time for questions for our experts. That means there's ample time for me to exercise the chair of the prerogative of the chair to ask my own questions. So I have two. One, Deborah used the phrase "asleep at the wheel" in connection with potential reasons investors in SVB or others might be maybe not paying attention or letting things run. But I always wonder in situations like that whether an equally relevant explanation is that they were reliant to some extent on a perceived safety net, perceived likelihood of rescue. Now, for the very largest banks, it's very obvious from the precedent set decade ago that, for the top 12 banks, their uninsured claimants are going to be rescued, and the resolution regime is fairly clear about who gets rescued and who's going to be bailed in and forced to take losses. But uninsured depositors at banks down below that top tier might think that they qualify because many of those banks were included in the stress tests in 2009, the so-called SCAP that kind of put a floor under equity for those institutions, or they might view that implicit commitment as ambiguous and somewhat uncertain in the case. So I just wonder if the two of you could comment on the extent to which the perceived federal safety net may have contributed to the dynamics we saw unfold and its ambiguity.
Debbie, you want to go
Debbie,
first?
you want to start?
No, okay, I can go first. And I say, my asleep at the wheel comment, I really don't believe regulators were asleep at the wheel. I mean, I think all the evidence is that they saw what was going on. They had a good idea that there was a lot of exposure. They chose not to act as aggressively as they might. So I actually brought that up to kind of dismiss it. I probably put less weight on the moral hazard of a bailout than others might. But let me and I want to talk about it from a regulatory perspective and also from an investor perspective. So from a regulatory perspective, the examiners at the San Francisco Fed, for instance, were not going to be happy if SVB was bailed out. So I think there is a huge cost to regulators if a bank under their watch fails. So I think that the fact that there might be a bailout isn't a reason for the regulators to kind of step back. They're going to get in trouble if there's a bailout. And then as far as investors go, I do agree that uninsured depositors probably had the reasonable expectation that they would be protected. But nevertheless, you should have seen maybe more reaction among the equity holders who were not going to be protected. But I think the market was aware that the risk was there, and maybe the risk premium in the equity got higher. But as I pointed out, equity doesn't provide a very clear signal about what's going on. It's convoluted with all kinds of other things. So, okay, I'll turn it over to Charlie and let him answer.
First of all, I agree with what Debbie said. I can't give you a clear answer to what people believed because we don't have any real indication of what everyone believed. Here's what we know. In the middle part of 2022, SVB lost 20 billion plus in deposits. So somebody was withdrawing a lot of uninsured deposits from SVB at a point when things were starting to look questionable. That was replaced, as I noted, by Federal Home Loan Bank loan, which of course was very counterproductive. So you could say, what are investors noticing through this process? Well, first, they might have noticed, as Debbie's completely correct, if you read the 10Ks, not only did the 10Ks tell you the phony number, the loss that wasn't being reported, they also have to give a risk assessment of what the big risk factors are. And they were very upfront about the fact that they were taking interest rate risk, although they didn't quantify it with a duration gap. So you would have known even as an outside investor. So then the question is, why did more than 20 billion withdraw? Well, it's hard to say. I would agree with Debbie. I think it was too small a bank for anybody to really expect the outcome of the bailout, even though in the event they were bailed out. So I agree with her judgment on that. I would also point out that this bank could have raised equity, and it seems to have had real franchise value, because in the auction, the acquirer made a killing from buying this bank, right? So apparently, this bank, the managers made a huge mistake. There were other idiosyncratic features that may explain that mistake, like the fact that in the 9 months prior to its failure, it didn't have a chief risk officer. So, maybe the bank was poorly managed. It kind of looks like that. So I guess what I'm saying is you could even explain the lack of further runs by the fact that the bank seemed to be a viable enterprise. And in fact, when it was auctioned, it looks like people still saw value in it. So yeah. I don't really have a good explanation. If I were hired by a consultant in the middle of 2022, I would have told them, do your accounting restatement, bite the bullet, raise new equity. You have a franchise, you have relationships that are somewhat valuable. Yeah. So it's hard to say. That it's a great question, Jeff, and I wish I could give you a clear answer.
Ask it.
Yeah.
So we actually have a couple of other members of the Shadow Open Market Committee in the room and on joining us virtually. And I'm going to start with them before turning it over to the audience here for questions. So if we get the Hollywood Squares version there. All right. Well, maybe not. We don't have 9, but you get the idea. But Mickey, did you have a question?
Yeah, I have a comment and a question. My comment, Debbie, and Charlie, is, if we really move to, a frequent reporting of the duration gap, which, as Debbie says, would be low cost, and in this world of AI, why can't it be done in real-time reporting? Then Debbie, you showed that the stock market response isn't very large, but I would envision if you actually went to a rapid real-time duration gap reporting by medium and large-sized banks, that there would quickly emerge quick responses in credit default swap market, and that could provide tremendous information about, that would reveal to the markets the implications of that duration reporting, and I think it would really enrich things. So in this world of AI, why can't banks report daily? Okay, so that's
I don't. Yeah. Okay.
Okay. My question is, both of you emphasize the need for a systematic framework and less reliance on discretion. And I'd like you to discuss the confusions within the Fed of who supervisors report to, the dotted line versus the solid line. And obviously the supervisors in the 12th district in San Francisco knew what was going on at Silicon Valley Bank. Why didn't they take steps? I'm not only talking about the need for a systematic framework, but how would it be implemented, and what are the inhibitions now with the awkward administration of supervision?
That's a good question.
So let me give 2 quick responses and then turn it back to Debbie. So first of all, on your observation, I don't think it would be so easy to have a daily reporting of a duration gap, because banks don't know even their own accounts on a daily basis.
Why not?
Well, I mean, that's a longer answer. It's hard to know everything that's happening in real time, but I don't think it's really necessary. But what we know is possible is a monthly disclosure. By the way, I fully support Debbie's proposal. And I want to emphasize that one of the consequences of the 1980s crisis, in which the problem of duration gap was so important, was that it became a part of the bank's mandate to measure its interest rate risk. And not just large banks, small banks too. I was the chairman of the board of a small bank. I can tell you at our monthly board of directors meeting, we had a full reporting, not just of duration gap, but of all of the statistics, the full curvature of the interest rate risk exposure, because it was part of the examination process. So every bank knows on a monthly basis the statistics that Debbie's talking about, and every examiner knows the record of the banks having computed them. It's just a matter of disclosing them. And I think it may be too hard to track on a daily basis what that is, but it's not really necessary. Monthly, I think, is good enough. And then in the answer to your second question, I think the key is two pieces. Information that's on the dashboard that everyone knows is on the dashboard, the supervisory dashboard. So a distance to default measure, which I had developed with my team at the OCC, 3 different ways of measuring it, using basic finance tools. You could add more to them so that you have a measure on the dashboard of the regulators for every bank that gives a summary statistic of distance to default. And then the second crucial part is a timeline requiring action, specific actions as a consequence of that getting to be problematic, so that the burden then becomes on the supervisor to say, why haven't I forced that bank to recapitalize 90 days after that measure got to that point? You can still give discretion to say, I'm not going to, but now you have deviated from the rule in using that discretion, and you've clearly taken personal responsibility for having done so. By making it clear, by having a clear criterion that's based in good thinking called distance to default, and by having a clear specified timeline, you can still preserve discretion, but maintaining a new burden of proof on someone that makes the incentive and agency problems that tend to favor delay far less. So that's my answer. Debbie.
So I agree with everything that you said, not surprisingly. I'll add that I think that a kind of a monthly frequency is pretty much enough, because it definitely picks up big changes. You know, duration doesn't change very quickly. The way it can change quickly is with moves in derivatives positions, and maybe that's what you're thinking you would pick up. I just wanted to add an interesting fact, which is SVB reduced their use of derivatives dramatically exactly at the time when you would have thought that interest rate risk was going to become a bigger problem for them. So it's really interesting that it appears like they might have been hedging and then they weren't. And you can, you know, you would have picked that up with kind of a monthly reporting of their duration gap. And that also speaks to Charlie's hypothesis that really it was their bad management, bad risk management was certainly at play there. In terms of what the regulators should do, I've said my piece. I worry about relying on discretion. I think the full vision of what I really think you could do with duration gap, and in some ways it parallels what Charlie wants to do with distance to default. They're very related. It's just that I'm looking at an interest rate dimension, is to say the existing regulatory framework sets capital requirements based on things like risk-weighted assets, and banks get to choose to take more or less credit risk in order to trade off the benefits of making riskier investments with having higher capital requirements. I actually envision that the best use of a duration gap would be to explicitly incorporate interest rate exposure into capital requirements. So rather than telling banks they could or couldn't take a certain amount of interest rate exposure, which to me has a bit of a flavor of micromanaging it, and it's usually not necessary, they could simply have the same kind of trade-off. If you are taking more measurable interest rate risk, that too will feed into a formula that affects capital requirements. So I'm just not going to go to a place where I'm going to talk about bank examiners should have more discretion or they should do more, because it makes me very uncomfortable.
If I could just add from personal experience within the system, at least up to 7 years ago, about the question about the examiners themselves. So little known fact about the governance of supervisory activities in the Federal Reserve System is that the legal authority to do that is lodged with the Board of Governors only, not the reserve banks. But the reserve banks, when the board got this authority, were already doing it sort of on behalf of the OCC. And what's evolved is a system where all these reserve bank employees who are doing supervision are deemed to be doing it under delegated authority. Another inconvenient fact is that it turns out there is no document delegating that authority. This was an informal arrangement created in the 1940s. Now, since the last crisis, a tremendous amount of work has been put into the Fed to formalize responsibility, authority, delegation, and how that works for the very largest banks. That is a more informal arrangement down below the largest banks. And the way I understood it to work is that the supervisory staff at the reserve banks were hesitant to do anything without consulting the board staff that supervised that particular bank or that particular set of banks. And so there was a very tight exercise of control. But at the same time, the arrangement allowed for the plausible deniability, like at the beginning of Mission Impossible, Jim, if discovered you're the secretary will disavow knowledge of your actions, right? So, and we sort of saw some of that playing out seemingly, I don't know, but seemingly in competing narratives that emerged in various media accounts that seemed to originate in different parts of the system. Sort of an unfortunate look. But yeah, it's an area that I hope the system will address at the regional bank level and tighten up that accountability. Going forward. So let me turn to other shadow members.
I have a question.
Or Atanasio.
Thanks, Jeff. So it's sorry I'm not there with you today. It's wonderful presentations, Charlie and Debbie. So I wanted to ask very specific, concrete, and in my view, simpler recommendation to see if Debbie and Charlie would agree with me. One of the problems highlighted was the accounting rules. One of them, the held to maturity. Why do we still have it? I mean, why don't we have a voice among the economists who understand how this is mismanaged to simply hide losses? So could you make a clear recommendation that, yes, that's one of the first things that should be done since it has not been done yet? Get rid of the held to maturity tricks to be hiding losses?
You're asking me, the answer is yes. If you want to know the weird, I can't talk about all of the conversations I've had about this because I don't want to impugn anyone. But I do want to say that one of the things I've noticed is that my colleagues and friends who are accounting professors are opposed to getting rid of hold to maturity accounting because they have, in my view, an aesthetic attachment to the idea that under some circumstances, hold to maturity accounting may be more accurate. Now, I'm just telling you, that's a cultural and, in my view, an aesthetic answer
Kind
to
of
your
like a
question.
stopped clock being right every now.
But I'm just making an observation. Every financial economist at a recent meeting that I was at said, this is obscene. How can this still be true? But every accounting professor said, but wait, there's this aesthetic beauty to this, the fact that it could actually be useful. So that's my own interpretation. I have no better answer.
Any clues, Debbie?
No, my very short response is I 100% agree we should do away with using held to maturity accounting for regulatory evaluation. I finally think we have an issue where we could issue a joint statement by the SOMC because we're always looking for things we agree on. And here's one where I think we have a chance. So that would be great. I've spent my career trying to get governments to use fair value accounting. So this is just another footnote. I would say that though, another observation that a co-author of mine once made when we were talking about accounting was that in the modern world, it's possible to report a lot of different numbers. So you can report held to maturity values, and you can also report mark-to-market values. And if you report both, you're giving investors more information. So I fully endorse using the mark-to-market numbers for regulatory reasons, but I don't want to prohibit held to maturity reporting. I just want to make it less focal, and maybe that would help the accountants that are holding out wind up on the same page.
Let's turn to the audience, see what questions there are on the left, all the way on the left by the windows. Gentleman with the plaid jacket.
Your name.
I wore the black jacket so I can be identified.
Very good.
Good morning. I'm Philip Chow. Two questions, both to Charlie, I think. One is that really you're talking about there are 600 banks who are all underwater in some way or another, or expect to be.
Mhm.
Can you share with us what the seems like a predictable future is going to look like? Even though we have lots of wonderful conversation about what can be done, I'm not hearing that's what will be done.
Right.
So as a result, we are seeing a train wreck.
Yep.
And if we're seeing a train wreck, what should we be thinking about? Number one, that's sort of one. Number two, I think, Charlie, you were rightfully critical, I think, about the $20 billion that was quote unquote given to make up that hole, that really meaningless. And number two, how the Fed has basically said, no, I'm sorry, the Treasury basically say, no worries, we'll back every dollar. I think as a man on the street, I'd love to hear your thoughts on, because most people are not as sophisticated as this group. So even the 24/7 press is not going to understand 90% of what you just talked about. So that created a lot of fear in the marketplace. And so I think from men on the street looking and say, boy, run on the bank, I better go and do something, and want to see the government in some ways covering the basis. So sort of psychological human behavior discussion. But yet, of course, it's not going to be effective, because just because the government says so doesn't make me feel that I shouldn't move the money.
Mhm.
But I don't think one cancel out the other. It's just my man on the street kind of vision or view. I'd love to hear your thoughts on that going forward. Thank you very much.
Well,
So
that was a really interesting set of observations. Let's see if I can remember all of them as I'm trying to comment on it.
600 shoes to drop.
Yeah. Okay. So let's start there. So I want to emphasize this is something everyone can access. If you write down the name Jiang, Jiang et al., you can find 2 NBER working papers that this group of co-authors wrote. The first one was written in March of 2023 and pointed out that there were 200 banks that were in very vulnerable position just based on their interest rate losses, applying methodologies that were related to what Debbie's presentation did. And then they followed that up a couple months later with a paper that said, and if you looked at commercial real estate losses, here's another 400. So it's a total of about 600. What was interesting is that was just a bunch of academics, very good academics at top places, who were using publicly available data. So I thought that was interesting. When I was at a Fed meeting, and I was sitting with unnamed, I won't name them, high-level Fed officials, and I asked them, why are you sitting on your hands? Why is it that the supervisory apparatus isn't resolving this problem by forcing these banks to recapitalize? The answer that I will just say, a very high-ranking Fed official said to me with a straight face was, do you want to see the banking system get even more concentrated? And I thought, like, that would be like a number 10 on my list of things I'd be thinking right now. Like, what are you talking about? And I think there was also concern about reduction in credit supply in certain locations as a result of this. In other words, myopic short-term politics. Why aren't more people reacting in the public, which is another part of your question? I think they already did. So certainly nothing that Janet Yellen or the Fed did stopped the money from flowing from small, medium-sized banks to large banks. But uninsured deposits have made their adjustment. The other thing that some banks did, they joined the CDAR system. So if you're a small bank, you join the CDAR system. That allows you to have effectively unlimited insurance on your deposits by swapping deposits among small banks. Or if you're a large bank, as Jeff pointed out, you're already protected under the implicit too big to fail protection from Title II of Dodd-Frank. So they already made their moves. I think the system has already adjusted to the uninsured deposits is my guess that of why there's peace on earth, despite the fact that we have 600 that are tottering. I want to emphasize you could force those banks to recapitalize. And the ones that are hard to recapitalize, you would make the tough decision, as Roosevelt did in March 1933 by originating the preferred stock purchase program. You put them into 3 tranches. Those that are good to go, those that are so desperately insolvent that they need to be shut down, and those that you might even want to assist with a preferred stock purchase program to encourage recapitalization. So if you think that, as this one Fed official said to me, that we're so worried about the credit contraction results of the 600 banks, which, by the way, I think is overstated, but nonetheless, if that's a real concern, then we are in a democracy. Fix that problem. Of course, we don't have a Speaker of the House, much less a functioning Congress. So I have some sympathy for Fed officials, Loretta, in the light of the fact that we're operating a democracy that is even more dysfunctional than the Federal Reserve, and that's hard.
Other questions? How about way in the back, the guy who has a black jacket on? Here we go. He's standing up.
I have a question for Debbie and one for Charles. On the duration gap, are we looking at actually marking to market the deposits as well, or only the assets? Because if you have a 5-year deposit at 2%, shouldn't it be lower than par in your liability side with the current interest rate scenario? And if you have like a compensating deposits, how should we measure those, which are no cost deposits? And for Charlie, when you mentioned a couple of times the increase in value of the purchases of the banks, I think it's you neglected to say that they cherry pick the assets, so they're not actually. We're not comparing apples with apples. We're comparing apples with oranges when you buy certain assets, because if you cherry pick the assets, you certainly are going to create value, but the FDIC expecting to take a loss on the rest. So shouldn't we net those things in the analysis of whether the FDIC did the right thing or not?
So Debbie, maybe go a little faster. We've got a lot of questions and only about 10 minutes. So
Debbie first.
Quick answer.
I'm so sorry. There was a technical difficulty, so I was. Could you really quickly repeat that question? There was
Yeah.
How do you
or
deal?
let Charlie answer his question.
It was about deposits.
In your calculation of duration gap, how should you mark deposits? And he questioned whether deposits, I guess CDs, should be marked differently.
Yeah, so that's a great question. I think there's been a long literature on the question of what really is the duration of deposits. It's kind of a technical question. I think that I don't think that answer has to be definitively resolved for the statistic to have value, as long as deposits are treated consistently across banks and consistently over time, because it's really changes in the duration gap that would be telling about an increase in interest rate risk. So that's my fudge, but I appreciate that it's a difficult issue and I'm working on it, but I don't want to give a more technical answer at this moment.
So my quick answer is, I think that I would go with what I would call simply the contractual answer to the duration gap for the deposits, even though there is a literature, as Debbie says, that argues that beyond the contractual gap, there's a behavioral duration of deposits.
That's a good way to put it.
So I would just go with the contractual maturities as defining, so that a demand deposit has a zero maturity, a 90-day CD has a 90-day maturity. And although it may be true that reactions of depositors indicate stickiness of deposits that would prolong their duration beyond their contractual length, I think that should be ignored in the computation that Debbie's suggesting. That's just my view.
Right, because you never know what kind of tweaks they're going to get.
Yeah, I agree with that completely. But if you were setting capital requirements, you'd have to, give a little leeway for the fact that deposits are actually stickier.
So quick answer about cherry picking assets for the buyer.
So I agree with you that there is some adjustment there, but I don't think that, I think my answer still holds, that the value to the acquirers was exceptionally large, and that it indicates most importantly, that those assets that were bid upon were, let's say, not disposed of in a very efficient way, and that furthermore, that there was value to those franchises so that they would have been able to recapitalize in 2022, likely, if they'd been pressured to do so.
Gentlemen in the fourth row or fifth row, depending on how you count them. No, one behind you. I'll go to you next. Oh, sixth row. Here we go.
Sixth. So speaking of sticky deposits, you know, I think on the last day of SVB, 40 billion left in the afternoon, right? You know, of deposit withdrawals, and in like a 4-hour period, and that was really possible because of technology and the speed of information, and it was really an incredible thing that no one's ever really seen before, and it's probably going to happen again, and it's probably going to be bigger, right? So, and given that all banks take some level of duration mismatch, right? Aren't you kind of dancing around the real issue, which is for demand deposits, there really shouldn't be much of a carry trade allowed, right? And because this phenomenon is going to get worse, you know, SVP mainly held treasuries, right? At the end of the day, they were going to be money good. That made nobody feel any better. Okay, so it strikes me that, you know, a little more aggressive position might be warranted.
So I want to emphasize that the carry trade in today's world is not an inherent feature of banking. I want to emphasize that for a couple of reasons. First of all, loan contracts can be based on flexible rates, so that you don't necessarily have a very long duration in loans if you don't want to. And secondly, whatever the duration gap is coming from the contracts you enter into on both sides, you can then adjust that with hedging.
You can lay it off.
So duration gap is not something banks must maintain. You can decide, in fact, what I teach MBAs in advanced corporate finance is, if your value creation as an institution is to take relationship-based risk, because that's where you're creating value by building relationships, you should actually hedge your non-relationship-based risks so that you can deploy more capital to what your comparative advantage is. So actually, banks probably today, in today's world, shouldn't have to take much of it. But I don't know if I answered that question.
Debbie, do you have any comments?
Just very quickly, I think we can't solve run risk with clamping down on interest rate risk taking. It's just overly ambitious. So it wasn't really a duration issue. So duration is asking how much the sensitivity of the value of these things to a change in interest rates. The runs weren't a response directly to changes in interest rate. They were a response to the pending insolvency and views about what was going to happen. And so they're just kind of orthogonal. And I just, the whole point of my proposal is to try to really improve things a lot on the dimension of interest rate risk without being overly regulatory. And I think stopping banks from using deposits to fund things for the reasons that Charlie said would be a terrible idea. That's how they add value. And then just a small technical point is the duration gap is inclusive of derivatives. So to the extent that a bank did use derivatives to hedge, it would be taken into account.
All right. Well, it's worth pointing out though that even if the bank were to shrink the duration gap to zero, totally avoid duration carry trade, right? The held to maturity accounting gives them a perverse incentive, diminishes their liquidity in a sense, and it provides a huge cost to them actually selling things that are underwater, and that's not reflected in the duration calculation. So it's worth pointing out that.
No, I think this is a really important point. I tried to emphasize it in my presentation, that once you've chosen hold to maturity accounting, there are all sorts of discrete costs to you of doing certain things like hedging or selling securities. That's another reason we want to get rid of hold to maturity accounting.
Right. Oh, okay. So gentlemen in the third or fourth row in the middle here, I promised. There we go.
Thanks for your talks. I'm sympathetic to the idea of using option adjusted equity value to supplement book value of the bank, or even mark to market value of the bank. However, most large banks are not traded. They're actually held by a holding company, is my understanding. the holding company is traded. So Citigroup is traded, but Citibank is not traded. So we saw in 2008, the value of Citigroup went from $50 to $1 or whatever. Adjusted for option value, that was probably negative. But what does that tell us about the underlying bank? The Citigroup was not insured. The Citibank was insured. So that's what we're worried about is what's the value of Citibank, not Citigroup. I mean, Citigroup can go by the wayside and Citibank is still standing, supposedly, theoretically.
Okay.
So with respect to calculating distance from default measures, you're right that observable market values of equity are extremely useful, but they're not absolutely necessary. So when we were developing at the OCC, 3 different methods for measuring distance to default of banks, market value of equity and volatility of equity was only one of those methods. So I want to emphasize you can use other sets of information. And then when you know, if you have information about bank holding companies, you can still see what the implicit information is about the bank if you have ways of measuring the relationship between the holding company exposure and the bank exposure. So that I agree with you, and that's a great point that you're making, that holding companies and banks are distinct, but that doesn't really obviate the ability to do this. Even for banks that don't, whose holding companies have no stock traded, you could still do it.
Debbie, any remarks? And this is our last question.
No, I'll let us end on time. That was a good answer by Charlie.
Excellent. So we take a break now. Sorry about the other questions. You can ask the participants, or at least this one, while you're huddled around the coffee in the back, and we'll reconvene at 10:45, 15 minutes from now. Thank you.
Good job keeping us on topic and keeping it good comments too.
Yeah, they
That
were.
was
They were
fun.
good comments.
Was it good?
Well, good morning again, everyone. Glad to have enjoyed that first session on banking policy and the ways that it can be considered within the recent history of some recent bank runs. The second portion of our presentation today is going to be more focused on the Federal Reserve's objectives with regards to inflation and unemployment. But if we kind of, take a step back, we recognize at this point that, we're living in pretty complicated economic times. Everything from, a return from a full pandemic shutdown to a strategic pivot in China, a country for which we have strong and have historically over the last number of years had a very strong trade record with. We now have both war in Europe and some very difficult conflicts in the Middle East. With regards to thinking about how monetary policy, can navigate us through this time period, I just want to just remind people about the history over the last few years. In 2012, the Federal Reserve adopted a framework that included a 2% target. And for the next almost 10 years, the Federal Reserve delivered low unemployment and an inflation rate that averages a little under 2%, probably about 1.6%. In August of 2021, the Federal Reserve adopted a new framework that included a few new wrinkles. One was that it allowed for a bit of an asymmetry with regards to the treatment of inflation and unemployment. And it also introduced a concept of something closer to average inflation targeting. And all this was based on a situation of what was a very low interest rate environment for a whole host of reasons, which I'm sure we will cover in the next little bit. There's, to think about this low interest rate environment is quaint. It's only been since August of 21 that we adopted it, but it seems like that's well in the rear view mirror. And I'm sure the conversation about the Fed's new framework will during today's conversation, we'll probably talk about the Fed's possibly newer framework. Just to give you the quick macro rundown, inflation had stayed quite low up and through the pandemic. Soon thereafter, in around early 2021, core PCE year over year crested at about 5.5% in March of 22. It has been brought down till recently. The most recent measure, that same core PCE measure, is down to about 3.9% in August. There'll be another data point in just a few weeks. All during this time post-pandemic, for at least the last year or two, unemployment has stayed reasonably consistent in about the 4% range or sub 4% range. Because of this new inflation environment that the Fed has been navigating, there obviously will be interest in how monetary aggregates can best interpret and predict the rise of prices, which is a historical notion, and one that I think we'll see just some very strong evidence for. In addition, one of the other tools that the Federal Reserve has used is forward guidance. Forward guidance can be a huge benefit to the implementation of monetary policy. Athanasios, in the final paper of this session, will talk a little bit more about if that had caught them in some difficult terrain, given their past commitments to that forward guidance. So the first two papers will be on monetary aggregates, what it means for inflation and thinking about inflation. The first paper will be by Peter Ireland, and the second one will be by Mike Bordeaux. Please, Peter.
Terrific. Thanks, Greg. I'm going to try and stand up while I talk, but I got to make sure I'm on the camera. Is it better to be here or there?
That's right. Pick your
Okay.
camera.
Good.
Go left, young man.
Thank you. That camera. Okay. Thank you very much. So, slides, please. Okay. Oh, great. Okay. So, a key principle, maybe the defining principle of monetarist economics, is that The stance of monetary policy, be it expansionary or contractionary, is typically signaled most clearly by taking a look at the growth rates of the broad monetary aggregates. From that monetarist perspective, the last several years have formed a truly astonishing episode in US monetary history. During 2020-21, money growth ran at rates in excess of 20% per year. Money growth has since not only subsided, but turned negative, signaling an equally extraordinary period of outright monetary contraction. So the question we face today is, what does this monetary contraction tell us about the stance of Federal Reserve policy right now? And by extension, what does it tell us about the likely trajectory of inflation going forward? Now, in order to answer those questions, there are several complicating factors that we're going to need to deal with first. And let's see. Clicker's not working. Can you advance? Thanks. So the first and most obvious complicating factor is that this monetary contraction, it doesn't come at us out of the blue. Instead, it follows, as I said, an equally amazing period of unusually rapid money growth. Just to see, what I've done here on this first slide is to plot the year-over-year growth rates of 3 monetary aggregates. Up in the left-hand corner, that's the Federal Reserve's official M2 measure. The other 2 graphs plot the growth rates of divisia or weighted monetary aggregates. Divisia M2 includes all of the assets in the Federal Reserve's official M2 measure. Divisia M4 expands the set of assets still further, most notably to incorporate securities issued by the shadow banking system. Now, at times in the past, these different monetary aggregates have behaved somewhat differently, but the reason for showing you all 3 here on the same slide is just to reassure you, for the current period, the last several years, it doesn't really matter which measure of money you look at. The story is exactly the same. Again, money growth rates in excess of 20% during 2020-21, money growth rates turning negative more recently. And again, the question is, to what extent does this recent monetary contraction just make up for, does it correct for the excessive money growth from years before? One way of getting a handle on this is to turn to the next slide, where I replot the series. Instead of plotting growth rates, I'm plotting levels, or more precisely, percentage point deviations of each monetary aggregate from the trend line that it was on before 2019. So once more, you can see it doesn't matter which aggregate you look at, the story is exactly the same for the most recent period, at least. Money rose about 20% above trend by the end of 2021. And since then, about half of that gap has been closed. Now, the second complicating factor closely related to the first, and this is correct, next slide. It is that no one, certainly no one at the Federal Reserve, but no one that I know of, even outside the Federal Reserve, is arguing that we have to bring the aggregate price level back to the trend line that it was on before 2019. We're willing to let bygones be bygones. That would require a period of deflation, an extended period of deflation, just to make up for all of the inflation that we've had over the past several years. So people are willing to let bygones be bygones. I'm going to come back to that point at the end of my comments. But for now, we can simply take as given the goal, the immediate goal. It's just to bring the inflation rate back to 2%. And with reference to this graph, what that means, or these graphs, what that means is the blue lines, they don't have to go all the way back down to 0. Monetary policy simply needs to be calibrated so that the gaps don't start growing again. And then the third and final complicating factor illustrated on the next slide, it concerns movements in velocity. Velocity fell during 2020-21. Again, it doesn't matter which aggregate you look at. That helped insulate partly, though not completely, nominal spending from the great increase in money growth. So nominal spending growth did accelerate, but not by as much as M2 itself. On the other hand, monetary velocity has bounced back since then. So even though we've had outright monetary contraction, that hasn't required nominal spending to fall. It's simply given rise to a deceleration in nominal GDP growth. Okay, so we have several things going on all at once, and reason to think that maybe these factors are going to interact in complicated ways to shape outcomes going forward. Under these circumstances, it's sort of really hard to use the mental math to work out in one's head exactly what's going on. It's helpful to have a little analytic framework that helps us keep track of everything and predict as best we can what's going to happen next. And fortunately for us, there is an analytic framework on the next slide that we can take right off the shelf that, as I'll explain, is ideally suited for our purposes today. And that analytic framework is given to us by something called the P-star model. So the P-star model is a single equation forecasting model with quantity theoretic foundations developed at the Federal Reserve Board in the late 1980s under the direction of then Chair Alan Greenspan. And here's what makes the P-star model ideal for our use today. It uses, as it turns out, information in the level of the money stock to forecast future changes in inflation while accounting for movements in velocity. So going back on the next slide to the pictures we were looking at before, the idea is, look, M has declined, the price level has risen, and we're willing to let that be a bygone. Meantime, velocity is shifting all around. Okay, so how can we take all of those factors, put them together, and again, predict what's going to happen next? Or to put it most bluntly, is the current level of the money stock relative to trend consistent with the return of inflation to 2%? Okay, so on the next slide, I illustrate or outline the basic idea. The P-star model takes as its starting point the quantity equation, MV equals PY, and it rearranges so as to define the variable P-star that gives the model its name. We can think about P-star as like the long-run equilibrium nominal price level that's consistent with today's level of the money stock M. Equilibrium in the sense that this is the price level that we would expect to prevail once velocity and real GDP return to their long-run natural or trend or long-run equilibrium levels, V star and Y star. So what we can do is to use an estimate of the trend component in velocity and real GDP to estimate quantitatively V star and Y star. Take any of the three monetary aggregates we were looking at before, M, plug it into the formula, compute P star, then compare P star to the actual price level P. Let's suppose that in spite of all of the inflation that we've already seen, the price level is still below P star. M is still in some sense too high. Then we wouldn't be able to expect inflation to go back to target because monetary policy instead is putting upward pressure on the price level so that P converges to P star from below. But let's say it's the other way around. The decline in M coupled with the rise in P that's going to be a bygone has put the actual price level now below P, above P star. That means monetary policy is appropriately contractionary, consistent with the return of inflation to lower levels as the price level converges to its equilibrium value from above. Okay, so on the last set of slides, what I do is to plot with the blue lines the natural log of the value of P star implied by each of our three monetary aggregates. Again, they differ slightly, but not by much across the three panels. The red line, in the meantime, it's the same across the three panels. That's the log of the GDP deflator, the actual price level. And once more, it doesn't matter which measure of money you look at, the story is the same. The blue line is way above the red line in 2020-21, indicating that from a quantity theoretic perspective, monetary policy was putting strong upward pressure on inflation. But notice that today, the situation is reversed. Again, the price level has gone up a lot, but we're not going to reverse that rise in the cost of living, just bring the growth rate of prices back down to 2%. Meantime, money has fallen, the blue line has fallen, indicating that monetary policy is now appropriately contractionary from a quantity theoretic viewpoint. From a quantity theoretic viewpoint, the actions taken by the FOMC so far, raising the federal funds rate, shrinking its balance sheet, are consistent with a return in inflation to 2%. So that's the good news. Before I wrap up, though, on the last slide, I just want to go back to this issue of letting bygones be bygones, because look, I consider myself a pretty nice guy. Like, I don't like to criticize, okay? But, okay, but this is important, okay? Even if the Federal Reserve succeeds in bringing inflation back to 2%, and even if it does so without putting the economy through a recession or maybe not even a significant slowdown in economic growth. Yes, in a way that would be great, but it's not going to be enough to render the last 4 years of US monetary history a big success. In fact, I regret to say it's sort of like the opposite is true. A lot of us on the Shadow Open Market Committee and a lot of people in the audience too warned that the revisions made to the Federal Open Market Committee's intermediate term strategy following the 2019 strategic review introduced into that strategy some pretty severe inflationary biases. No one could have predicted the exact chain of events that have unfolded over the last 4 years. On the other hand, given the inflationary bias that was built into the strategy, in some sense, unwanted inflation was kind of inevitable sooner or later. So somehow, after inflation gets back to 2%, the FOMC needs to find its way back to the best practices that it followed pre-2019. And what did that involve? A preemptive move to prevent inflation from rising in the first place, rather than partial damage control ex post. Okay, so thank you very much.
Yeah, thank you so much, Peter. Now I'd like to get Mike up there. Oh. Got it. We can't hear you, Mike. Still can't hear you, Mike. We'll just give it a second or two, and if not, we can always go. Okay. Not, we can always pivot. It might be a little out of order, but we could go to Athanasios if we have to, and then double back. Hey, Athanasios, you ready to go?
Sure.
Okay, we'd love to hear from you.
So thanks, Greg. And yeah, it would have been better if you had the two money presentations before, because I was going to offer the other monetarist interpretation of how we should be looking at the stance of monetary policy, which is focusing on real interest rates, not nominal, real interest rates. So let me do that, and then we go to Mike. So if you can please share the slides and go immediately to page number 2.
Yeah, just wait 1 second, Athanasios. 1 second.
So it's while the slides are being loaded, the title of my presentation is "Has the Fed Escaped the Forward Guidance Trap?" And what I would like to do, if you can go to slide 2, please, is try to explain how we got to the place we are. So much like Peter was saying before, it's useful to understand why we ended up with this episode of high inflation that has created this challenge for the Fed right now. And I will link this to the implementation of policy strategy, as Greg pointed out in his introduction, and specifically one feature, which is the way in which the Federal Reserve implemented forward guidance due to its preference, its unfortunate continued preference to be discretionary, which is an issue both for monetary policy and, as we saw in the previous panel, for regulatory policy as well. So how did we end up with high inflation? Well, in summary, the Fed used its discretion to peg the federal funds rate at 0 for too long after the pandemic. As inflation started to rise when the recovery came in 2021, actual inflation was rising, expected inflation was rising. The Fed continued to be stuck with 0 interest rates. And what that meant is that the Fed was pushing systematically real interest rates to fall and keep falling to more and more negative levels. And this is how it was providing excessive accommodation that is just not consistent with good policy. And that's the other way of noting what Peter was just remarking a little bit earlier. We can see this excessive accommodation both with monetary aggregates and with real interest rates. If you could go to slide 2, please. So the question is, what explains this error? And I will highlight the role of forward guidance trap in this error, and try to explain in simple terms how the Fed managed to fall into this trap in 2021, and then conclude by assessing where we are right now, whether the Fed managed to escape the forward guidance trap, and where what needs to be changed going forward to reassert a good policy. If you can go to the next slide, please. So this slide simply summarizes the stance of monetary policy. It shows the federal funds rate in orange, and also forward-looking measures that capture the whole package of policy and policy communication. It shows the 1-year and 2-year overnight index swap on interest rates. And what I want you to focus on here is, if you check after the totally appropriate provision of tremendous accommodation in 2020, the problem that we can see here is maintaining that tremendous accommodation effectively all the way through to the end of 2021. And it was this additional year of accommodation that was quite excessive. Of course, after the Fed recognized that there was a problem with its policies, then we can see the very rapid adjustment in nominal interest rates that was one of the factors causing the problems on the banking system, on the banking side, that we discussed in the previous one. Now, if you can go to the next slide, please. So the question is, how could we have been tracking in real time, not retrospective, the emergence of the inflationary problem, and how soon should the Federal Reserve have picked this thing up? Well, one way of doing this is with inflation expectations, inflation forecasts, and we have the SEP forecast that the members of the participants of the FOMC were providing. We do not have the staff forecast. We're gonna have them in 4 years. But another way of looking at it is using information from financial markets. What I show in this chart is 1 and 2 year ahead implicit inflation expectation measures that we can read from inflation swap rates, and also to track the credibility of the Fed at the longer end, the 5x5 forward rate shown in the orange line. What you can see here is that already in real time, by the end of 2020, the recovery had taken hold, and forward-looking measures of inflation were suggesting that the economy was doing quite well, and if anything, already in early 2021, there were some risks of inflation. Now, in my view, the Fed was quite appropriately reluctant to start normalizing interest rates in the first half of 2021. There was the issue with low inflation, as Greg summarized earlier, before the pandemic, and there was considerable uncertainty in the early months of 2021 with the pandemic. But then as 2021 progressed, you could see that forward-looking measures of inflation expectations got worse and worse. We had 1 and 2 year forward measures effectively reaching 4 percentage points already in the second half of 2021, and we can see that the longer-term measures of inflation expectations were suggesting some concerns of disanchoring that the Fed should have been worried about. If you could go to the next slide, please. So the issue is that what matters for the stance of monetary policy is not the nominal interest rate that the Fed was keeping at 0, but real interest rates. And because of the implementation of the policy strategy that the Fed has adopted, as inflation was rising and inflation expectations were rising, the Fed ended up adding excessive and inappropriate accommodation to the economy throughout 2021. And you can see this here. These are the 1 and 2 year ex-ante real interest rates implied by the OIS and inflation swap rates. And you can see that while it would have been very reasonable to have these interest rates at -1, -2, and indeed, if you go back to the previous episode when we had liftoff following the global financial crisis, you can see -2, -1% interest rates were as low as the Fed ever got. The Fed was careful not to provide excessive accommodation at the time. In this episode, in 2021, the Fed kept easing policy, kept pushing interest rates further and further down to -3, -4% until in early 2022, they started realizing how disastrous this was for inflation and reverts course. And we see the incredibly fast tightening by historical perspectives over the last 30 years that moved us to now we are at between 2 and 3 percentage points positive real interest rates at the moment. Next slide, please. So the issue is how would we characterize good monetary policy if we wanted to check the correlation, just a simple correlation of real interest rates and short-term and medium-term inflation expectations? And the answer is that any reasonable model that we could write down would suggest that as inflation and inflation expectations are exceeding the central bank's inflation target, then the real interest rate should actually start rising instead of falling. But what you see here, if you check what the Fed did in 2021, is exactly the opposite. By keeping the federal funds rate stuck at zero, effectively, the Fed implemented for a couple of years a massively negative correlation, adding accommodation exactly at the wrong time when inflation was peaking up. And this is how we can see the forward guidance problem that the Fed had. Now, what created this problem? And I want to spend a few minutes explaining how we can relate the problem to the Fed strategy. Next slide, please. I will discuss briefly two elements. One element, and this actually goes back to something that Peter mentioned that is very, very important. We know that for monetary policy to be effective, monetary policy needs to be preemptive. And my recollection is when I was inside the Fed, when Peter and Greg and others on the shadow were inside the Fed, this is how the Fed operated. So we know that 1994, if you recall, was the so-called first preemptive strike against inflation. It wasn't the first. The first was actually back in the 1920s. But since the mid-1990s, the Fed tried to be and was quite successful, I would say, in being preemptive in its policy. So one of the mistakes that we saw during the pandemic is that the Fed decided to totally disregard its preemptive approach to policy and move forward guidance from being forecast-based to being outcome-based. This is one problem. The second problem was the implicit commitment to gradually reduce net asset purchases, linking balance sheet policy to interest rate policy, which meant that if for whatever reason the Fed made the mistake of promising continuing asset purchases for a few months longer than those would have been appropriate, that also delayed interest rate normalization, pushing the Fed, effectively guaranteeing the mistake that we saw being further behind the curve. Next slide, please. So the first thing I want to do here is simply show you the comparison of the last meeting before the Fed became myopic in 2020. You can see here that July 29 statement, you have a very forward-looking statement of forward guidance. The Fed was saying that it would keep policy effectively at zero, as long until the economy was on track to achieve its price stability goal. Because at the time, there were concerns that inflation would persist to be too low. And then in the middle quote, I want you to see this is right after the adoption of the revised strategy statement. We see the statement of the September 2020 meeting, where the Fed says instead that the policy would stay at zero until labor markets have reached full employment and inflation has risen to 2%. And this is a fully myopic, backward-looking condition, both on employment and on inflation, that virtually guaranteed that if anything happened with even a mild inflationary shock, the Fed would be behind the curve. Now, I want to be clear here. The strategy statement that was adopted in 2020 did not preordain this mistake towards myopia. It actually did give other elements. It could have been interpreted differently. These myopic clauses that were added in September did not have to constrain policy in 2021. There were opt-out clauses that were actually described in the minutes of the meeting, but effectively those were ignored. And we can see this by looking at the third quote I have. This is the chair responding to a question in November 2021, by which time it was way too late already to start raising interest rates. And the chair was explaining that the committee had not even discussed whether it would raise interest rates because one of the lift-off tests that had been specified in September 2020 were not yet met. Next slide, please. So this is one complication. The second complication was the interaction with the balance sheet. Again, I start with a quote here from the November 21 meeting from the minutes. By that time, it was perfectly clear to outside observers that the Fed was behind the curve, and it's pretty clear reading the minutes that FOMC members themselves recognized that there was a problem with policy. But apparently, they felt constrained to doing anything with interest rates because of the implicit suggestion that they shouldn't adjust interest rates until they first ended net asset purchases and then desire to be extremely slow in ending asset purchases. So we can see at the next meeting in December, the committee already recognized that there was too much accommodation in the system, still nothing. And then in January, finally, they decided to announce that in early March, they would stop the net asset purchases. And effectively, with this announcement in January, the Fed pretty much signaled to markets that they would start raising rates at the March meeting. Next slide, please. So next slide, please. Yeah, thank you. So the question is, has the Fed escaped the forward guidance trap that led to this? And here I just focus on the last 4 years. You can see the error that resulted from the incorrect implementation of an incomplete framework in 2020 and 2021. But then you can see that since the Fed started raising interest rates in 2022, they have indeed been quite aggressive. And when I look at this chart, I see that the 2-year interest rate, which I take as a summary of the overall stance of monetary policy, the 2-year real interest rate has risen to above 2 percentage points. And the Fed has been pretty good in maintaining that tight stance of policy in the last, over the past year. And in that sense, this aggressive tightening has helped the Fed put in place sufficiently restrictive conditions that if the Fed maintains the sufficiently restrictive conditions, then the Fed will indeed manage to restore price stability. And this is a good thing that I think monetary policy is as a member of the committee of the Federal Open Market Committee stated a couple of weeks ago, is in a good place today. And this is a good thing. So for the time being, the other good thing is that the Fed has abandoned its flawed approach to forward guidance that had been adopted in 2020 and created this mess in 2021. However, the Fed has not changed its overall policy strategy and communication and continues to exhibit a preference for unhelpful discretion. The Fed had a couple of opportunities already to revise its statement, and it hasn't. It didn't do that this January, in January of 2023, the last time they had it. And I very much doubt that they will revise the strategy statement in January of 2024, which is something that I believe is needed to improve policy. And then the Fed hasn't yet considered adding some guidance that would make its policy more systematic. In my view, for example, a simple benchmark rule that is forward-looking based on short-term forecasts of the economy would serve as a useful benchmark for policy. And providing a rule like this would actually be quite useful for communicating future monetary policy and providing forward guidance as well. If you can go to my last slide, please. And I want you to just focus on the last bullet in this slide. This is not a new debate. Greg pointed out the Fed adopted a strategy statement for the first time in 2012, and there were a number of good things in that statement. Most important, the clarification of the price stability objective to 2% inflation. But back then, there was a live discussion about how to improve strategy in other directions and also how to provide forward guidance. And I want you to see the quote I have at the very end. For example, Charlie Plosser, who at the time was a member of the subcommittee that came up with the January 2012 statement, was arguing that articulating rules as guides provide the best kind of forward guidance, which would have been helpful in stabilizing the economy and the path of inflation. If only the committee had taken Charlie more seriously back then, we would not have had the problem we had in the last couple of years. And I think it's worth revisiting those discussions and going over Charlie's comments again to improve policy going forward. Thank you.
Thanks so much. We're going to give Mike another go. Mike, we're hoping for about maybe 10 minutes here.
Okay, can you hear me?
We're good.
Okay, can you please show my slides? Okay, well, I'm sorry I can't be there. I'm out at Hoover this week, and I'm sorry for the tech because being in a different place from when I'm normally at, things sometimes don't work. My paper is with John Duca, and it really complements what Peter Ireland said, and I'm covering a lot of the same ground, but perhaps through a different set of glasses than him. Next slide, please. Okay, so, and our talk is called Money Matters, and it basically gets right at the same question Peter did. So if we look at the last few years, we've had excess aggregate demand, and we've had high nominal GDP growth, which has led to been followed by high inflation. Next slide, please. Okay, yeah. So this is the picture. It shows you the departure of GDP from a trend, and it shows you how much some of that has gone into inflation. Next slide, please. Okay. Yeah. So the traditional Chicago view, MB equals PY, that Peter told you about, says that if velocity is stable in the long run, too much money growth is going to eventually fuel high inflation. Next slide, please. And you can see this. So this looks at broad divisia money. That's divisia M3, and I'm going to explain what that is. And Peter used it, but you do see that broad divisia money rises and rises before nominal GDP, and you see this very rough correlation. Next slide, please. Okay, but one problem with using with using targeting money, which is what the Fed did up to about 20 years ago, is that the demand for money, or velocity, was not very stable. And so people kind of forgot about it and just totally forgot about the monetary, except for us at the Shadow and a few others. And so when we did have a run up in inflation, which occurred after rapid money growth, people kind of say, what's going on? So we're going to get back at this issue. Next slide, please. Okay, so this shows you why they didn't believe that money could matter, is because the velocity of simple sum M2, okay, just falling off a cliff and has been very unstable. Next slide, please. Okay, and so for many reasons, divisia money is better than simple sum monies. What you do is with it, and I'll describe it as I go forward, you improve both short and long run models of the demand for money or velocity, and we find that it's reasonably stable. Next slide, please. So this shows you the blue line is the simple sum measure, and the red line is divisia member. So what we're going to do is focus on the red line. Next slide, please. Okay. And what happened was that during the GFC, global financial crisis, V3, the velocity of M3, broad money, fell as uncertainty raised the demand for money, and then it recovered. Same thing happened in the pandemic. Now it's recovering. Next slide, please. Okay, you can see this picture where you've got these circles show you these two big drops in velocity in these crisis shock events, and then they come back. So this is what we're in, the second one, and we're in a bounce back. Next slide, please. Okay, so what divisia does is it treats the price of monetary services as a differential between the interest rate on a risk-free asset that doesn't provide monetary services and one on a monetary asset that does. And so what you do when you use money is you give up this interest differential. And this, as with any price, divisia assumes that the margin utilities of services provided are proportional to their user cost prices. And so the growth rate of a divisia index is the weighted average of the growth rates of the components, and the weights are the average expenditure shares. And expenditure on each component is equal to the user cost times the holdings. And what happens is with simple sum money growth rates, you just have the same weights. And so what happened is that the growth in higher interest bearing money components gets less weight in calculating the growth rate of the divisia indices than in the calculation of simple sum monetary aggregates. Next slide, please. Okay, and so what we do in this paper is we model divisia M3, and we take into account, just for recent years, the last 20 years or so, and the velocity of divisia M3 is affected by financial innovation, by new assets, financial engineering that affects the relative liquidity of illiquid assets versus liquid divisia monetary assets. And so what broad divisia money has been affected by is changing liquidity of non-money stock equity assets associated with regulation and falling mutual fund transfer costs. And so if mutual fund costs rise, okay, velocity falls. And if you have new laws that make stocks more risky, like the CFMA derivative law a few years ago, that's going to affect velocity. And also velocity would have been affected during the COVID restrictions that we had a couple of years ago. And what we do is we try to account for that. We track the COVID effects by the Oxford Government Restrictions Index. And so what we do is we adjust the behavior of velocity for these mutual fund costs, derivative regulation, and the pandemic. And we find that when we do this adjustment, that you can pretty well come up with a nice fitting velocity function in the short run and the long run. So next slide, please. Yeah, so this shows you this measure of the pandemic this Oxford index, which measures the restrictions that occurred, and it shows you that it explains some of the bounce back that's been occurring in velocity. Next slide, please. Okay. And so we have in the paper, it's a paper, and there's a lot of it in it, and we can't do it all here. It works pretty well. We get stable and significant coefficients. We find that equilibrium velocity leads actual velocity by about 4 to 5 quarters. We also do short run models, and we find that that works pretty well too. So I'm not going into that. I'm just going to apply what we find. Next slide, please. Okay, so this is just the picture we have. So this shows you the actual behavior of velocity in black, and the blue line is the model that we did, which accounts for these institutional changes and COVID. Next slide, please. Okay. Yeah, but now we want to use this to say, well, what's going on now? What are the effects of monetary policy going forward, and what happened? What happened in the pandemic and the recovery? And so it's still not 100% sure how much velocity is going to recover from COVID. And so what we did was we looked at 3 paths of recovery. Next slide, please. We call them high, medium, and low. And so the three, they're at the very right-hand side of the slide, you see what happens in the future. So velocity snap back, and what's going to happen? We have these different scenarios. Okay, next slide, please. So it's uncertain how much velocity is going to recover. And so what we did is we did these three paths of velocity. And then what we did is, given the paths of velocity, we add in different growth rates of divisia M3, and then we can use that to forecast the path of nominal GDP. And this is, the paper explains how we did this. But what happens is we make assumptions about 3 possible monetary M3 growth paths. And in a sense, there are 3 scenarios for when the Fed policy stance gets back to neutral. And we define neutral as the point where we get 4% divisia M3 growth, which gives you about 4% nominal GDP. And so we had these 3 scenarios, one which we called a modest, where money is flat in the 4th quarter of this year, and then it goes up to 4% in 2024, and then you get back to neutral. A slow one where money is flat, and then it rises to 2% in 24 and 4% in 2025, and you get to neutral back in 2025. And then sort of a partial one where money is flat in 2024, and then you get a sudden return to neutral. And the slow path gets you to 3 to 5% nominal growth in 24 to 25. The partial redemption gives you negative nominal growth until late 2024. And all the paths basically suggest that it's going to be a protracted return to the pre-COVID path. And what's going on is that you're seeing the interaction of money growth and the lag recovery of velocity from the pandemic. And in a sense, what this picks up is the long and variable lags that Friedman talked about. So next slide, please. Okay, so this is the modest one, and it basically tells you that there's tightening, then the velocity is going to adjust with the lag, and then eventually you're going to cruise back to stability. Okay, the next slide is next slide is the slow pattern, and again you get a much bigger drop here. That you get, in a sense, if we follow the second scenario, there's a pretty good chance we're going to have a recession. And then the third one, next slide, please. Yeah. Okay. So, so is there another slide? Yeah. Okay. So basically what we do is, we follow a simple quantity theory framework, which says that too much money is going to chase too few goods, and you're going to get inflation. That was discredited in the 80s and 90s because of the instability in money demand or velocity, instability of M2. So what we did was we developed a divisia money demand or velocity function, which we find is both stable in the short run and long run. And in a sense, you can, with that, the evolution of the Divisia M3 growth and velocity can, when you adjust for COVID, you can help track the recent path of nominal GDP. And what's going on is that you get this lagged adjustment of Divisia velocity to the uncertainty shocks of the pandemic. And that explains the slow response of nominal GDP and inflation to the fiscal and monetary policy expansions of 20 to 22. So Mickey and I had a paper at Hoover last year where we talked about the Fed being behind the curve. In fact, we forecasted, Mickey and I, way back at the beginning of 2021 in 2 Wall Street Journal articles, that we were going to have high inflation, okay, because we were thinking in terms of this framework. And of course, that happened. And so what that tells us is, because you get this lagged adjustment with velocity, when you account for that, it suggests that it's going to take a while for the Fed tightening to work out. But likely, it's going. There's a decent chance that they may have already tightened too much. And so what our research suggests is that there's information in properly measured monetary aggregates that should be considered. Another way of putting this is money still matters. Thank you.
Yeah, maybe just let me focus on a bit of the commonality. Both Peter and Mike, talk about the movement of monetary aggregates properly measured with the, relative interest rate service flows, weighting the different components of these monetary aggregates. In addition to that, though, they do point, and you can see it in Peter's graph pretty succinctly, the gap between P and P star, is significant, and probably, I don't know if it's ahistoric or it's maybe probably one of the largest gaps between the two, but it does tell you that, there will be a correction, it will be slow, and this points to the kind of connecting point between what Mike just said and what Peter brought up. I do also want to kind of focus on something that also connects all the papers, and that's this very strong tradition, but both between the quantity theory in terms of the work that Athanasios suggested, that there's importance of rules in the making of monetary policy and how that can ultimately provide better outcomes and better stability. I just want to maybe just compare and contrast that. It's not quite a question. I want to ask each participant to just comment very briefly on this, and I'll open up to questions, which is, the Federal Reserve uses a fairly, or the FOMC tends to use a different mantra rather than saying, rules-based. They try to use the term data-dependent in terms of they're making decisions, they're looking at the world, they're being data-dependent. How close is that to the based framework? I'll start with Athanasios first, and then I'll switch over to the other two.
Thanks, Greg. So data dependent in my reading means as discretionary as possible.
Yeah.
It doesn't really provide any explanation about what exactly is the expected response to new data coming in. And it's also not helpful in the sense that it distracts attention from the need to be forward-looking. What policy is doing when policy is well run is look at what current data and analysis imply for the outlook for inflation in the economy, and then respond accordingly. And this is how the Fed has been responding really since the mid-1990s, since 1994 quite clearly, until 2020. This was pretty much done. What was missing from that was some additional clarity on what the benchmark rule is, so that I think would have helped avoid the mistake that we saw a couple of years ago. Now, you can do this thing either with monetary aggregates or with interest rates. As it came out in the presentation of monetary aggregates, the issue with monetary aggregates is really tracking the equilibrium, velocity, and the dynamics. And this is not an easy task. There is some work there. The other one is, I want to make a comment on what Peter presented. Greg will remember this from the time we were both in monetary affairs trying to work with, trying to estimate the equilibrium velocity and the P-star model. To apply that framework, you also need good estimates of real-time estimates of potential GDP. which is problematic. So you can design a good rule, and you have to be careful. The real-time issues associated with measurement are actually similar. R star is an issue with interest rate rules. V star is an issue with money rules. Potential output uncertainty is an issue with both types of rules, and one needs to be looking at robust approaches to provide good preemptive guidance.
Thank you. Peter, any quick comments on that?
Sure, just two quick comments. Actually, number one, regarding money versus interest rates, I always really liked the ECB's two-pillar framework, which the European Central Bank had at its founding, and unfortunately, they've abandoned it too. I think that it makes a lot of sense to run parallel economic and monetary policy analyses, one based on what I'll just call a Keynesian framework built around the idea that the central bank affects economic activity by adjusting interest rates, and then inflation responds to measures of slack, but also to use a quantity theoretic framework as a cross-check. Strikingly, as the presentations today pointed out, regardless of whether you take a look at the real interest rate or whether you look at money growth, there were pretty clear signals in 2021 that the Fed was falling behind the curve. So perhaps having a two-pillar approach where both pillars were indicating the need to tighten policy, that might have really helped. Let me just mention one other thing about rules versus discretion. I think, looking back, Athanasios is right. The 2012 strategy statement is, in my view, about as good as it can get when it comes to building a consensus in a big committee about what monetary policy can and should do and how it should go about doing those things. The one missing piece, though, was supplementing the words with a concrete policy rule. And, that gets back to the piece by Charlie Plosser that Athanasios cited at the end. What I really think is too bad is this. One of the great strengths of the Fed Reserve System is its decentralized structure and the independence of thought enjoyed particularly by the Federal Reserve Bank presidents. If I was advising a Federal Reserve Bank president, or if I was a Federal Reserve Bank president, here would be the challenge I would offer. For a couple of years, just try it. Start every speech by saying, I sat down with my research department and we settled on this rule. Maybe it's a Taylor rule, maybe it's a money growth rule, just some rule. Okay, evaluate the current stance of monetary policy according to that rule and compare it to what the committee is actually doing. I guarantee that that would lead to better outcomes than simply, as Athanasios said, making policy decisions meeting by meeting and relying on data dependence. It's really just a rolling story to justify discretion.
Thanks. We'll go with Mickey, and then I'll jump to some others, please.
I just want to bring Mike's and Peter's discussion of money and velocity into the current context. Okay, so we've had this deceleration of nominal GDP in response to the Fed's tightening, and we're all very lucky that the largest portion of the deceleration in nominal has been inflation rather than real. But bring it to current events. The nominal GDP growth is decelerated to about 6%. It has to come lower to be consistent with the Fed's 2% inflation objective. In Q2, it was 3.8% annualized. But wait till you see Q3 when it's published. It's going to be at least 7.5%. Okay, so that brings into question, and that's entirely consistent with Mike's model and your model that velocity is increasing. You have a decline, either M2 or Dvicia, and nominal GDP is accelerating. So you're seeing a big pickup in velocity now. And then the question is, what about going forward? And so I just want to bring their work is so important now in the current context.
Yeah, let me just briefly respond to that. You're absolutely right. I mean, the third quarter is going to show a very strong GDP number. Keep in mind, though, that when you do year over year, an even stronger quarter is going to drop off. So year over year, nominal income growth will still show deceleration. Okay, I guess what I would say is, as long as I continue to see that steady deceleration in year over year happening, I'm happy to say, like I think it was Athanasios, that monetary policy is appropriately calibrated at present. But sure, if the strong third quarter turns into an equally strong fourth quarter, and that strength in nominal demand carries into 2024, yeah, that means there's going to be more tightening that's needed.
Right, please, I'll go with Jeff. I'm going to break my rule and then I'll go to the back. Sorry. Please, Jeff.
Very quick question. I'd be interested in my shadow colleague's reaction to the following sentence that has been uttered, or a version of it's been uttered by several members of the Federal Open Market Committee. The rise in the bond rate is doing our work for us.
My reaction would be that interest rates can be potentially misleading indicators of the stance of monetary policy. This is the key question. Does the high 10-year bond rate mean that real interest rates are going back up? Or does it mean that inflation expectations are being embedded into financial decisions? Historically, what's been the solution? To look at money as a cross-check.
If I may, Greg, Greg, if I could say something on the question, on Jeff's question.
Go.
Okay, thank you. So it's and Jeff, you're absolutely right. That of course matters. So the way I'm thinking about forecast-based policy rules is kind of my a rule I consider a benchmark is effectively considering the 3 quarter ahead year over year nominal GDP growth compared to real-time estimate of potential GDP growth. So by doing that, if a tightening of financial conditions is projected to influence the economy in the next 3 quarters, and I expect that that would happen as a result of the increase in longer-term interest rates, that will already be incorporated in and would suggest a little bit less tightening would be necessary. So the whole point, the way I see it, is have a robust rule. You can do the same thing, by the way, with money growth targeting. Really, the instrument is not the crucial thing. The crucial thing is to be aiming to stabilize nominal GDP growth to be consistent with real potential GDP growth and the 2% target in the medium term. And this is what Peter suggested the money pillar would be telling you, and this is what well-designed interest rate rules be telling you. And if you are somewhat forward-looking, you will pick up the tightening of financial conditions already in there.
I agree with both of you guys. I mean, the 2-pillar approach is something that was very valuable. They saw it as a check. And they said, if we look at this, we want to see if the other policy, the interest rate policy we've been following works. And I think that's what we want. My work with Duca suggests that you want to use some monetary aggregate as a cross-check or as a leading indicator, but something that can supplement what you do and maybe not switch back to monetary aggregate targeting, but don't throw it out the window.
Please, yes, sir. Yes, you glasses over here. Gentleman with the glasses up there. There you go. Sorry, I took mine off, so it's tricky.
I guess for both Peter and Mike, in order for a monetary aggregate to be useful for controlling inflation and the price level, it has to have a stable real demand, and also the Fed has to be able to control its nominal quantity. So if Divisia M4 has a stable demand, how does the Fed control the nominal quantity of Divisia M4? I mean, if
I'll start with
pre-2008, with a simple M1 model, you could say, well, there's a simple multiplier, but how does that work for Divisia M4?
I'll start with Peter, and then we'll go to Mike.
Oh, do it.
Oh,
Mike may
please.
have an answer.
Mike, please. Mike?
Oh, yeah. I think that is the issue. That there's a link between what the Fed controls, which is the monetary base, and how that gets into Division 4. So obviously that gets back to the questions that were raised a long, long time ago about the endogeneity of money and of the stability of the money multiplier. So, Houston, your comment's right. So I wasn't advocating that we get back to base control. I was really advocating that money aggregates can be a good measure of information, and they can continue with their interest rate approach.
Yeah, they can be an indicator of the stance of monetary policy without being a tool or an instrument of policy.
Yeah.
Please, in the back there. Yep. I'm just guessing.
First of all, great presentations. Thank you very much for sharing that with us. From a simple point of view, the title of the subject is, do monetary aggregates matter? Given the change in velocity and the very dramatic change in velocity, you had a situation in 2018, 2019, and 2020 where money supply was going gangbusters, and yet no inflation whatsoever. There was some inflationary expectation pickup, but the actual inflation was very low. So do money aggregates matter? And now with the evidence, not the evidence, but the recent data with the fluctuation in velocity, does money demand overwhelm money aggregates? Thank you.
Peter? Yeah.
Right. I would say when you take a look at intermediate term trends in nominal income growth, the answer is yes. The movements in the growth rate of money over the last 4 years have been big enough that even though velocity, as you say, has tended to offset them, the offset's been partial, not complete.
That's right.
There you go. Please up here. Yeah. Sorry. We'll go him then you. Nice. Okay, there you go.
Divisia M's, when one of the big problems that when we tried to use them back when the simple sum M's were going astray was that there were about 20 different ways to calculate them, and none of them were sort of saleable to the public or even to economists for that matter. Is that your current Divisia M's, are they consistent over time, or are they modified according to a well-stated rule, or what? And if I can get away with the second question, I do want to ask a little bit about 2020 and why that hasn't been part of the discussion.
Well, I think we've talked a lot about Divisia. We can go deep into how we measure it, but let's talk about your 2020 question. What exactly is your 2020 question?
My 2020 question is, at the time we had what a non-economist said, well, it's obvious we have too much money chasing too few goods, but the too few goods we don't want to do anything about because we're mandating too few goods. And yet everybody acted as somehow the goal was still to create more goods. But anyway, that's my other question.
I mean, my personal view is there were just a whole host of complicated supply constraints during that time period that coupled with kind of the interruption in just major trade with China that obviously disrupted the balance between demand and supply of goods. I think over time people have seen those recede a little bit, but I think it was a problem in terms of the creation of inflation that these supply conditions did not unwind in a pace consistent with keeping the price level stable. Please.
Greg, can I answer the 2020 part?
Yeah.
So I tried to touch briefly on it. We discussed it at earlier meetings. In my view, Policy in 2020, especially the response in spring of 2020, was very good. It was very important to be indecisive. The Fed was decisive, correctly so. It did a better job than after the global financial crisis, drawing lessons from global financial crisis. And then I would not have read, and at the time, the wrong signals from M2, for example, and other monetary aggregates. I mean, this is where people at the Fed, like when Greg and I were in monetary affairs, this is part of what the division was doing at the Fed. You're cleaning out special factors so that you can look at the underlying trends. So in 2020, part of the increase in M2 was very mechanical, the fiscal support that was being sent in checking accounts and so forth. If the staff were using monetary aggregates as a second pillar, that Peter and Mike and I would support that as well, it would have cleaned up these things and would have looked at the underlying trend. So that would have provided a very useful basis for avoiding the mistake in 2021, much like the interest rate signals were suggesting 2021 was a problem. So I don't think 2020 per se was an issue. It's a question of how do you use the information to make sure policy is consistently good, not just as it was in the first half of 2020.
Yeah, I want to go back to what Anne-Marie, the first part of Anne-Marie's comment, which is about measuring division in such a way that it can be explained easily and that it's consistent over time. And this has been a problem. And what we're trying to do, and others, is to try to come up with a measure of the divisia M3 or divisia M that can go back far in time. And we made these adjustments for the last 20 years or so. But when you go back further, the deregulation that occurred in the 70s and 80s, it still doesn't work very well. So what you need to do is to come up with something that works over maybe 50 years of data, and we hope to do that, and come up with some very simple ways of solving these complicated calculations in a way that's convincing. And that's still the holy grail of this research. So, I totally sympathize with what you said, but we are hoping to improve upon that.
All right, I'm going to break the rules. We're going to go for the very last question. He's got the mic, and then it's lunch. I apologize, everybody. We can discuss this further over lunch, please.
Quickly, Peter, you said nobody wants to go back to the 2020 prices. You haven't met my wife. More broadly, you talked about the increase in money, and the Fed was putting reserves in for a decade without significant increases in money. And then we went and borrowed 20% of GDP, and we've got a big increase in money. So it suggests there's a monetary mechanism transmitting the fiscal policy to the monetary values.
Right.
And also of the monetary statistics that you and your colleagues showed, and also the inflation swap statistics from Athanasios, and also fiscal policy. You have fiscal policy leading, monetary money supply leading. The swaps are following closely, but they're following the actual rise of inflation early in 21. And you have, I think you raise a question about the expectations theory of inflation, that expectations couldn't be lagging and causing the inflation. So first the fiscal monetary relationship, and then do we have questions as a result of the biggest inflation in 2 generations about the expectations theory of inflation?
Sure, we can talk more over lunch, but just very briefly, I'll have to talk to you more about exactly what you're asking. But what I would say is that even if you're not an adherent to the so-called fiscal theory of the price level, it seems pretty clear that highly expansionary fiscal policy did work to shift expectations this time around in a way that it did not following the global financial crisis. And I personally do think that's part of what's given rise to the inflationary environment that's followed. But let's have lunch and talk more.
We'll leave it there, everyone. Lunch.
There's no law against we have a 6 different candidates. We have 6 different candidates.
Ladies and gentlemen, please welcome Mickey Levy.
Welcome to our post-luncheon keynote speaker. So look, I have this just absolute, I've had this absolute pleasure and honor of knowing Loretta for the high quality of her research. We've known each other for a few years, or should I say, numerous decades. So she spent her career at the Fed in numerous research capacities, and for the last 9.5 years, you've been president of the Federal Reserve Bank of Cleveland. She's just this absolute tireless worker and very thoughtful policymaker. So when I think about, the whole array of presidents of the Federal Reserve banks, Loretta just not only played a vital role, but she's always thinking about the proper role of the Federal Reserve in pursuing the Fed's dual mandate, and the proper role of the president of a Federal Reserve Bank. And very favorably, she favors more systematic approaches to the conduct of monetary policy, and also, and this is in her writing, she puts more weight on the medium-term outlook because she understands the pitfalls of data dependence. So in the last session, there was discussion about data dependence and discretion, and Loretta's actually written about the pitfalls of data dependence and overweighting the most recent monthly observations. Okay, so in October of 2016, at an SOMC meeting, Loretta was the keynote speaker, and her paper was entitled Acknowledging Uncertainty. And it was just extraordinarily thoughtful, and it described the different types of uncertainty, and it led her to say, I favor using inputs of different monetary policy rules as a benchmark for assessing current policy. And she also recommended the benefits of the FOMC publishing confidence bands around their quarterly economic forecasts. And boy, I mean, so prescient to thinking about, all of the problems the Fed has now in its forecasts and how and the uncertainty around those forecasts. And so today, uncertainty abounds, and through it all, Loretta has emphasized the economic benefits of low inflation. And recently, she stated that the risks to inflation remain tilted to the upside. And while we have not yet completed the journey back to price stability, this is quoting Loretta, there should be no doubt that the FOMC will get the job done. And those were bold statements, and we're looking forward to Loretta now with some more bold statements today. So the SOMC, and we warmly welcome you.
It's always dangerous when someone quotes your previous speeches to be consistent. So I really appreciate the introduction. I really thank the Shadow Open Market Committee for inviting me to speak today. Well, the SOMC is known for fostering an active exchange of diverse views on the economy and monetary policy with the aim of contributing to better policy decisions. And I also believe that robust policy discussions and deliberations are very constructive. So I'm really looking forward to the question and answer part of the program today. But I thought, like, to help frame that discussion, that I would present a review of economic developments and my perspectives on monetary policy. And I should say that the views I present are my own, not necessarily those of the Federal Reserve System or of my colleagues on the FOMC. So Jane Austen is often erroneously credited with having written, "It isn't what we say or think that defines us, but what we do." So that sentiment is only partially true in monetary policy making. It's true in the sense that a central bank will lose its credibility with the public if it merely says it's committed to 2% inflation, but doesn't take action to bring high inflation down. In this case, high inflation could become embedded in people's view of the economy and affect their behavior in ways inconsistent with price stability. making it much harder for the central bank to achieve its policy goals. But the quote does not fully apply to monetary policy making because how and what policymakers communicate are very important in aligning the public's expectations with policy actions, and this alignment can make the actions more effective. Now, the FOMC's policy actions and communications have contributed to discernible progress on inflation. And as we calibrate policy to finish the job, as Mickey said, both word and deed will continue to be important. This is particularly true because the economic environment is quite uncertain. The events in the Middle East are still unfolding, adding uncertainty to what was already an uncertain geopolitical environment. The Israel-Hamas war is a human tragedy. It's too soon to determine the full economic and financial market ramifications of the war for the global economy, but they will need to be considered as we chart the future path of monetary policy to achieve our dual mandate goals. Over the past 3 years, the pandemic and its aftermath have been a major source of uncertainty. When the pandemic hit, the economy shut down in March 2020, and fiscal and monetary policymakers took aggressive actions to support households and businesses, ensuring that credit continued to flow and limiting lasting damage to the economy. When public health statistics began to improve in May 2020, the economy began to reopen. But it was not business as usual. Spending patterns had shifted from services to goods early in the pandemic and have only gradually been shifting back to pre-pandemic trends. Many people decided to leave the workforce when the pandemic hit and only gradually decided to rejoin. Now, the participation rate of workers between the ages of 25 and 54 has now surpassed what it was in 2019. But the overall participation rate is still below its pre-pandemic level. Remote work became much more common, and that led to changes in the demand for housing, and sales of new and existing single-family homes surged in 2020 and 2021. In addition, supply chains were disrupted, making it much harder for firms to keep up with the demand for their products. The changes in spending patterns, workforce participation, housing demand, and supply chains that arose during the pandemic are in many ways still shaping the economy. They led to a situation in which demand in both product markets and labor markets became out of balance with supply. Those imbalances occurred in an environment of accommodative fiscal and monetary policy, which helped to sustain the significant increase in inflation that started in 2021. Russia's invasion of Ukraine in February 2022, another ongoing human tragedy, added to inflationary pressures, spurring higher prices for oil, food, and other commodities. In 2022, headline inflation reached levels not seen in 40 years, running 7 to 9%, depending on the measure. Now, when inflation began moving up in April 2021, the FOMC communicated in its post-meeting statements that elevated inflation largely reflected factors that the committee expected would be transitory. By December 2021, the FOMC's view had changed and it no longer referred to inflation as transitory. In January 2022, the FOMC said that with inflation well above 2% and a strong labor market, the committee expected it would soon be appropriate to raise the target range for the federal funds rate. Financial conditions tightened in reaction to this forward guidance. Following through on its guidance, the Fed took action by raising the Fed funds rate by 25 basis points in March 2022 and has now raised the Fed funds rate by a cumulative 5.25 percentage points. We're also reducing the size of the Fed's balance sheet by allowing assets to roll off in a systematic way, according to the plan announced in May 2022. This balance sheet reduction is also firming the stance of monetary policy through its effect on the term premium on long-term bond yields. Now, the tightening of monetary policy has led to a broader tightening in financial conditions, and in response, aggregate demand has begun to moderate. At the same time, supply chain disruptions have improved, and imbalances between supply and demand are easing. Now, while demand is moderated, economic activity has been considerably more resilient than most forecasters, including the FOMC participants, were expecting. Consumer spending makes up about 70% of GDP. It's been increasing at a solid pace, supported by strong income growth and the still elevated savings accumulated during the pandemic. Bankers in the 4th District report there has been an uptick in usage of home equity lines of credit and credit card debt, suggesting that some households have exhausted ready balances. Delinquencies on consumer loans have also edged up, although they are still at historically low levels. Now, as savings balances normalize and credit conditions remain restrictive, consumer spending is expected to moderate. Businesses have slowed their spending on equipment and software this year, and it's expected to continue to moderate given restrictive credit conditions. In the housing market, activity has slowed, but the longer-term shortage of available housing has meant less of a slowdown than one would have expected, given that the 30-year mortgage rate is near 8%. The shortfall in housing supply has kept rents and house prices high. Now, in response to that evolving picture, FOMC participants' projections of economic growth this year were revised up in September. Earlier in the year, FOMC participants projected that growth would be well below trend in 2023. In September, the median projection was that growth would be a bit over 2%, which is somewhat above trend. Still, growth is expected to slow to below trend next year as tighter credit and financial conditions and waning fiscal support for households weigh on spending. Labor market conditions also paint a picture of moderation and resilience. Firms have reduced their job postings and more people are coming back into the job market. Firms report it's easier to find the workers they need. Still, labor market conditions remain quite strong. The unemployment rate is low at 3.8%. Job growth has slowed over the course of the year, but the strong reading in September and revisions to July and August data suggests the slowdown has been less than once thought. Payroll gains averaged about 300,000 per month over the first 3 months of the year, compared with about 270,000 per month on average over July through September. Now, restrictive financial conditions should help to continue to moderate labor demand, bringing demand into better balance with supply. The unemployment rate is likely to move up somewhat as this rebalancing occurs, but I expect overall labor market conditions to remain solid. Despite strong job growth in September, wage pressures are easing by some measures. Our business contacts expect wage increases to be less over the coming year than last year, except for workers with hard-to-find skills. But at 4%, expected wage increases are higher than before the pandemic and well above the level consistent with 2% inflation based on current estimates of trend productivity growth. Now, wage price dynamics can be quite complicated. An open question is whether inflation leads wage growth or whether it's the other way around. One wage Phillips curve model from the Cleveland Fed suggests that inflation leads wage growth, with the model attributing much of the high wage growth since the pandemic to the pass-through of higher inflation. On the other hand, other research from the Cleveland Fed that uses data from our business survey finds that firms are highly attuned to wage costs when setting prices. My conclusion is that we need to continue monitoring both wages and prices to assess whether inflation is moving down in a sustainable and timely way to our longer run goal of 2%. Now, inflation has been running well above the Fed's goal for more than 2 years, and it's still too high. That said, it's important to acknowledge the discernible progress that's been made on inflation, even while the overall economy has remained relatively strong. As of August, the headline PC inflation rate is running at 3.5%, which is half of its peak rate in June of last year. The underlying measures of inflation, including the core, median, and trim mean measures, have also moved down from their peaks. And the progress is easier to see when you look at the price changes over shorter time horizons, such as 3-month or 6-month annualized inflation rates. But the CPI report for September is a reminder that we cannot count on the progress continuing at the same good pace we've seen in recent months. Now, the larger declines in inflation have come in goods prices. Inflation in housing services, measured by rents and the imputed rents for owner-occupied housing, has begun to come down. But the recent CPI inflation report suggests that the adjustment could be gradual. The most stubborn part of the index has been inflation in core services, excluding housing. This component, which makes up about half of the consumption basket, has shown little improvement over time. Now, in my view, it's important to guard against becoming complacent if it takes longer and longer to achieve the Fed's 2% goal. When inflation persists at levels above our goal of price stability, the price level is moving up faster than we would like, and households and businesses are having to pay those higher than desired prices. In addition, high inflation distorts investment decisions, imposing long-run costs on the economy. In my view, the risks to the inflation forecast remain tilted to the upside. Oil prices are up on net since July and may pass through to other core prices. In addition, gasoline prices are higher than at the start of the year and are particularly prominent for households that have to fill up their cars or trucks once or twice a week. Rising gasoline prices could begin to make consumers think inflation will be rising again. Now, I don't expect that's going to move inflation back up to the very high levels we saw last year, but it could stall the progress we've seen over the past few months. A distinguishing feature of this high inflation episode compared with those in the 70s and early 80s has been the fact that despite high inflation rates, medium and longer term inflation expectations have remained reasonably well anchored in a range consistent with the Fed's goal of 2% inflation. Now, there could be several reasons for this, but one likely factor is that the Fed now has an explicit numerical longer term inflation goal of 2%. In addition, over this episode, we have communicated our commitment to achieving the goal, and we have taken actions to support this commitment. Our communications have been an important tool, policy tool, reinforcing the actions we've taken and making them more effective by anchoring inflation expectations. Ensuring that the public views the commitment as credible can reduce the cost of disinflation. Indeed, research indicates that the disinflation that then Fed Chair Paul Volcker had to engineer in the 1980s was costly in terms of cumulative output losses, not only because the Fed had to tighten monetary policy enough to get inflation down from high levels, but also because the Fed had to make the public understand that it would not abandon its commitment to price stability as inflation started to come down. Regaining credibility was important in moving the public's expectations about inflation down with inflation. During the current episode of high inflation, in addition to communicating our commitment to price stability, we have aligned our policy actions with that commitment. Appropriate words and deeds will continue to be crucial as we finish the job. And this brings me to monetary policy. So at its September meeting, the FOMC decided to maintain the target range of the Fed funds rate at 5.25% to 5.5%, and to continue to reduce the Fed's security holdings. Now, in determining the extent of additional policy firming that may be appropriate, the FOMC will be assessing incoming economic and financial developments, as well as the cumulative effects of the tightening done so far, since we know that monetary policy affects the economy with a lag. The economic projections released by the FOMC in September indicated that the median participant thought that another rate increase would be appropriate this year, and that monetary policy would likely have to be held sufficiently restrictive for a while in order to get inflation back down to 2%. This is consistent with my own reading of economic conditions, the outlook, and the risks to the outlook. But whether the Fed funds rate needs to go higher than its current level, and for how long policy needs to remain restrictive, will depend importantly on how the economy evolves relative to the outlook and how the risks are changing. So to guide my policy views, I'm going to be carefully assessing incoming evidence to determine whether the economy is evolving as expected. Risk management considerations are becoming increasingly important as we set monetary policy in a way that balances the cost over time of potentially over-tightening versus under-tightening monetary policy. Tightening too much would slow the economy more than necessary and entail higher costs than needed to get inflation back to our goal. Tightening too little would allow high inflation to persist with short and long run consequences and would necessitate a much longer and more costly journey back to price stability. Now, there's always uncertainty around the outlook, but uncertainty is higher in the current environment. In addition to the upside risk to inflation, geopolitical uncertainty has risen with implications for financial markets, oil prices, and global demand. The slowdown in the Chinese economy, the possibility of an extended UAW strike, and the potential for a government shutdown later this year all pose some risks around the outlook. The structural changes to the economy since the pandemic, including changes to the labor market and supply chains, also complicate the picture. Indeed, our models are trained on past data, but the pandemic was unprecedented, and that's complicated forecasting. Post-pandemic, it's become even more important to look at several models, examine different scenarios, and collect real-time information from regional context to inform policymaking. As the FOMC has communicated, two important considerations for calibrating monetary policy going forward are how much of the past tightening is yet to transmit through the economy and how restrictive monetary policy is. And we heard this in the last session. Monetary policy transmits to the broader economy by affecting overall financial conditions, but the magnitude, speed, and duration with which it affects the economy vary with the nature of the shocks that have hit the economy and other aspects of the economic environment. Now, it's possible the Fed's use of forward guidance has sped up the transmission of monetary policy to the broader economy, affecting financial conditions before the actual changes in monetary policy have occurred. For example, tightening in financial conditions occurred several months in advance of the first Fed rate increase in March 2022. Other research suggests that even controlling for the increased use of forward guidance and balance sheet policy, the lag in the effect of monetary policy on inflation shortened in the post-2009 period. On the other hand, there's a large volume of outstanding corporate debt and commercial real estate debt that will need to be repriced at higher interest rates over time. This suggests that past changes in monetary policy may be felt for some time to come in the economy. Since the lags vary across cycles, the benchmark against which shorter or longer is evaluated is not well defined. So a definitive conclusion about the length of the lag in this tightening cycle will remain elusive. A second policy consideration is the stance of monetary policy. While monetary policy is currently widely viewed as restrictive, the resilience of the economy as shown in the face of high interest rates has underscored the difficulty of knowing precisely how restrictive policy is, partly because of the uncertainty about the level of the neutral real interest rate, so-called R-star. In economic models, the longer-term neutral real interest rate is determined by the long-run growth rate of consumption and therefore output, and it's influenced by the trend rate of productivity growth, the growth rate of the labor force, and the demand for safe assets, among other factors. Now, before the pandemic, estimates showed that the longer-run neutral rate in advanced economies had been declining for more than 2 decades, reflecting the aging of the population, changes in risk preferences, and slower productivity growth. But in the aftermath of the pandemic, estimates of the short-run neutral rate rose. Now, whether that increase will persist is an open question. Projected longer-run fiscal imbalances are unlikely to be sustainable, and the government will need to respond with some combination of increased borrowing, reduced benefits, increased taxes, and program restructuring. In the meantime, higher projected U.S. fiscal deficits requiring higher government debt issuance will put upward pressure on the neutral rate. If new technologies like generative AI produce significant productivity gains, this would also put upward pressure on the longer-run neutral rate. But countervailing those effects are the continued aging of the population in advanced economies and investor demand for safe assets. I think the jury's still out I have not yet raised my estimate of the longer run equilibrium interest rate, but I'll consider doing so depending on how the economy evolves. In light of the cyclical and structural uncertainties and the need to balance risk, policy decisions will need to be guided by actual progress on our dual mandate goals, in particular, whether the rate of progress we've seen on inflation in recent months is sustained and whether labor market conditions remain healthy as they moderate. Because the outlook and balance of risk can change, policymakers will need to be nimble in order to appropriately calibrate policy in the midst of such changes. This is going to require us to carefully monitor economic, banking, and financial market developments. Now, one such recent development is the tightening in financial conditions since our September FOMC meeting. Restrictive monetary policy is intended to tighten financial conditions, but the increase in the nominal 10-year Treasury yield since the last meeting was larger than expected and reflects several factors. Like the Fed, market participants have revised up their expectations for growth this year. They've also likely taken on board the communications from the FOMC that monetary policy is likely to remain restrictive for some time based on the outlook for inflation and employment. Now, both of those factors suggest a higher expected path of short-term real interest rates and therefore higher longer-term yields. Rising term premia, the compensation that investors require to hold longer-term debt, has also contributed to the increase in Treasury yields. The New York Fed's estimate of the term premium on 10-year Treasuries, which had been in negative territory since mid-2021, turned positive towards the end of September. The recent focus on the U.S. fiscal situation, which will likely necessitate higher issuance of Treasury debt, likely contributed to the rise in the term premium. Now, one factor that does not appear to have contributed to the rise in yields since September is inflation expectations. Those measures have remained relatively stable. Now, if sustained, the increase in longer-term yields will help to moderate demand. And as one of the financial conditions we monitor, it will be one of the factors I consider when evaluating the appropriate path of monetary policy going forward. Now, regardless of the decision made at our next meeting, if the economy evolves as anticipated, in my view, we're likely near or at a holding point on the Fed funds rate as we accumulate more information on economic and financial developments and assess the effects of the tightening in financial conditions that's already occurred. So I think it's useful to think of monetary policy during this tightening cycle in phases, although the shifts from one phase to another depend on the evolution of the economy. So during the first phase of this tightening cycle, the monetary policy narrative centered on how fast should we raise the policy rate. So we began with a 25 basis point increase in March 2022, then moved the funds rate up by 50 basis points at our next meeting, and then followed with 75 basis point increases at each of our next 4 meetings. We then slowed the rate increases with a 50 basis point increase at the December 2022 meeting, and then a 25 basis point increase at the first meeting of this year. Now, over this phase, the committee communicated that it anticipated that ongoing increases in the funds rate target would be appropriate. At that point, the policy narrative entered a second phase, which centered on how high rates would have to go. The policy language changed to signal that the FOMC would be assessing the extent to which additional policy firming may be appropriate. If the economy evolves as expected, I believe we are nearing the end of this phase. The narrative would then be entering a third phase focused on how long monetary policy will need to remain restrictive. Now, getting away from the meeting to meeting guessing game of will they or won't they increase the funds rate would seem to add some beneficial stability, allowing firms and financial markets to absorb the increases in the pipeline. But communicating how the FOMC is thinking about the economy and monetary policy in this policy phase will be a challenge because it requires some nuance. The FOMC is committed to returning inflation to our 2% goal, and we would not be content with inflation settling at a level above our goal. But as we travel the last mile of getting inflation back to 2%, the balance of risk to our dual mandate goals will continue to shift And it's important that the public understand that the commitment to price stability doesn't mean ignoring the maximum employment part of the mandate or deliberately taking actions to drive the economy into recession for the sake of achieving the price stability as soon as possible. The balance of risk will change over time, and the Fed will continue to calibrate its policy in pursuit of both goals. Now, as I said, given the outlook, I anticipate it'll be appropriate to keep the funds rate at its peak for some time. Now, some commentators have suggested that this will result in a passive tightening of policy as inflation moves down. Essentially, they're measuring the real Fed funds rate as the nominal funds rate minus actual inflation, which is backward looking. I think a better measure is the nominal rate minus expected inflation, which is forward looking. So while I expect year ahead inflation expectations to move down as inflation declines, this may take some time, and maintaining the nominal funds rate in order to achieve that decline in inflation expectations is appropriate. Indeed, if the projected decline in inflation is conditioned on maintaining, the projected decline in inflation is conditioned on maintaining restrictive monetary policy, and a failure to do so could jeopardize achieving that decline. Now, eventually, policy will enter a fourth phase in which it's appropriate to begin reducing the Fed funds rate and moving monetary policy towards a more neutral stance. Given the lags with which monetary policy affects the economy, policymakers are going to need to be forward-looking and begin reducing the funds rate when inflation is still somewhat above our goal. At that point, it's going to be important for the FOMC to communicate that the Fed is not abandoning its 2% target and is not content with inflation remaining persistently above target. Rather, the message will be that the Fed is more confident that inflation is on its way back down to 2%, so less policy restraint is needed. Longer term, I believe communications could be more effective if the FOMC's post-meeting statement provided more information on the committee's economic outlook, its view of the risks around the outlook, and its evaluation of progress on its goals. Doing so would give the public a better sense of the FOMC's reaction function. And this would be particularly helpful in uncertain times like today, when it's important to maintain some policy optionality. Policy decisions should be guided in a systematic way by how the economy is evolving relative to our outlook, as well as to shifting risks around the outlook. But because the economy could evolve differently than anticipated, we need to preserve some policy optionality. This is what I call systematic optionality. It's different from setting monetary policy in a discretionary manner in which the policy reaction function is changing. A fuller post-meeting statement, I think, would help the public understand this difference and give them a sense of how the FOMC is likely to react if some of the risks are realized or new risks emerge. Lastly, when uncertainty is high, as it's been during and since the pandemic, scenario analysis, as advocated by SOMC members Mike Bordeaux, Andy Levin, and Nikki Levy, can be a helpful guide to monetary policymaking and communications. So the FOMC does look at alternative scenarios and alternative interpretations of intermeeting economic developments as part of our meeting preparations, which can help us avoid groupthink and be better prepared if the economy does evolve differently than anticipated. But recasting our SEP submissions to incorporate participants' views of potential salient scenarios, rather than focusing only on the modal outlook, could be quite helpful, especially in uncertain times. So I essentially did this with my SEP submissions during the pandemic. In this period, forecasting how the economy would evolve was particularly challenging given the uncertainties about the course of the virus and how households and businesses might respond. Indeed, in March 2020, given the immense uncertainty to the outlook, the FOMC refrained from collecting and publishing the SEP. When the SEP resumed in June 2020, I began formulating my outlook conditional on different scenarios on the path of the pandemic and our success at containing it. This approach gave a clearer picture of my view on the economy as distinct from my views on the course of the disease. The similar type of scenario analysis for different kinds of uncertainty would not be too difficult to incorporate into the SEP, and it could form a basis for policy communications that preserve optionality without suggesting that policy is being set in a discretionary manner. So to conclude, word and deed are important monetary policy tools, and the Fed will be using both to achieve its dual mandate goals of price stability and maximum employment. So that concludes my prepared remarks. Thanks for listening.
Well, you really were quite provocative and covered so many issues. Let's just open it up to.
That's another way of saying I talked too long.
That's not at all. Not at all. We'll just open it up. Charlie.
Okay. What a great presentation as usual, Loretta. It's such a pleasure to have you here with us today. And given our many years of friendship, I apologize for the difficult question I'm going to ask you. So you talked about the long run rate going up recently, and then you also talked about the importance of scenarios. So my own belief, which the Secretary of the Treasury agrees with, by the way, because in the February 16th, 2023 financial report of the US government, it says, quote, the projected continuous rise of the debt to GDP ratio from her report indicates that current policy is unsustainable. And so we're in an unprecedented situation. Some people are saying, as you know, that the bond market's reacting to these fiscal risks. And if the bond market vigilantes come back in force, so what I want to do is present you with a scenario and get you to react to it. Since scenarios, I agree with you, are pretty important. Suppose that over the next 6 months, that there's no change in monetary policy or the current stance of the macroeconomy, but that the 10-year rate rises by another 2 percentage points, and that there is a clear discussion in the bond markets and the financial press that this reflects growing concerns about unsustainable fiscal policy leading to some kind of fiscal dominance problem or something else. How should the Fed, this is an unprecedented challenge for the Fed, but what does the Fed do, or what should the Fed do? What are some of the options that Fed policymakers should be thinking about in their own policy reaction to that? Do they ignore it? How do they react to it?
I mean, I don't think you can say that we could ignore that, right? I mean, that just would be untenable. And I also think that the scenario you're putting out isn't quite that. I think that's like a set of measure zero in the sense that the outlook for the economy would change, right? So, I mean, in that sense, it's
just trying to make the hypothetical.
Yeah, but it's a hypothetical that I don't think would play out, right? Because if that were to happen, right, I think the whole outlook for the economy would change, and then we could still maintain sort of looking forward, right, and then setting monetary policy in that environment based on the changes in the economy. I mean, just think about what would happen to a whole set of other financial conditions if that scenario were to play out. But, you know, one thing that's interesting to me is, you know, this unsustainable fiscal policy, maybe exacerbated because of the reaction we had to do in the pandemic, which I think was the right reaction from both fiscal policy and monetary policy. But it is curious how it happened. People paid attention, or traders paid attention to it when it's a longer run issue. So I think it's an interesting, dynamics in the markets are very interesting because it's hard to explain why now that happened as opposed to this is something that's been known for quite a while. So if you guys can tell me why it happened now, I'd be interested in hearing more about that.
Yes. Way back.
Hi. In light of the earlier talks regarding monetary aggregates, divisia, and this is the greater stability of money velocity, and then Peter Ireland's suggestion of using this dual approach of making projections based on interest rates and also monetary aggregates, is there any chance that the FOMC will take that into consideration and start looking at monetary aggregates again? And if the answer is no, why not?
I cannot pre-see, what the FOMC will do. I mean, I can tell you that we do look at research And I think the papers presented today are certainly things that I'm going to be reading in more depth and considering as I look at I like to look at a lot of different indicators of the stance of monetary policy, because as I tried to point out, it's very hard to see it. So I'm certainly going to take a look at this and see whether I can incorporate it into my thinking about the economy. So I think we're always trying to learn from new research. And I would, say as one monetary policymaker, I'm certainly going to look at it carefully.
Thank you. Every time I listen to a central banker, I feel really soothed, just the way that you guys talk. So first of all, I really appreciate your presentation. So thank you for that. I think the common observation has been the last mile is always the most difficult. In other words, it's one thing to go from 9 to 4, and then it gets a little harder from 4 to 3, and then gets really hard from 3 to 2. The standard answer from, I think, the FOMC members is we're going to hold the rates higher for longer. Holding it for higher for longer, assuming is sufficiently restrictive. I'm rephrasing some of the words you're using. But you could hold it for longer and never goes from 3 to 2. Then it goes into this credibility discussion. What I understand from the past from your colleagues, Chair Powell and others, who has really trying to make sure that we don't stop, we as a group don't stop and have to go up and then stop and then go up and kind of playing these rates over time, but really to be more with a higher degree of confidence or certainty when you make those from phase 1 to phase 2 to phase 3 and ultimately phase 4. Sorry, this question goes on, I apologize. What I'm trying to understand is how do you think about higher for longer, which basically you're already in phase 3 because you're basically pausing, is my interpretation. But yet pausing is suggesting that it's going to get to 2. Otherwise, why would you pause? So I like to understand that sort of a nuanced difference between really getting to the last mile and get it to 2, vis-a-vis, yeah, I think we have a confidence of getting to 2, but if it doesn't, then we'll raise rates again. I don't think really that's where you're going. So sorry for that long.
It's a good question, and I try to finesse it a little bit by saying like it doesn't necessarily be that it's very clear when the demarcations of those phases are going to be. But you're right in the sense that what I would bring you back to is look at the projections of the SEP in the SEPs, right? So if you look at those, we do get basically back, I mean, we can argue about this, right, to 2% in those projections. I don't think that we'd be thinking about, right, we may be near the peak if we hadn't had projections that are basically coming down. Now, it could turn out the economy evolves differently than we expected. We know that we've been underestimating throughout this whole tightening cycle inflation, right, until recently, right? So early on, we were underestimating, and that delayed our taking action, right? So I don't want to give the impression that there aren't wide error bands around the forecast, but that would be the reaction. It would be like, you look at your incoming data, how does it change the outlook? If it changes the outlook sufficiently enough, then you need to change your policy, right, going forward. And that's the mechanism. So I can't stand today and say, are we definitely at the peak? I can't say that because the economy could evolve differently than I anticipate. But from my forecast, right, I would say we're basically, within one, of the peak. Then we can hold it there for a while and see if the economy is evolving as we anticipate it, according to my forecast. If it is, then okay, then I have, built into my forecast, us taking the rate down at, late next year. If it doesn't, then we may have to reevaluate our policy decisions. But I think that's very consistent with what we were talking about earlier in the session, right? Is that you have a reaction function. The reaction function isn't moving around, but the inputs into the reaction function could evolve differently than you anticipated when you're setting policy today. And then you'd want to follow your reaction function, and you might have to change interest rates. And on the other side, it could be that the economy evolves in a way that we're not anticipating for the other part of the dual mandate. And that would also affect your policy decision going forward.
Doug, and then
First, you show a lot of courage to accept all this constructive suggestions. Long term, your framework, your big balance sheet. It seems that forces flowing from the big balance sheet are often operating at cross purposes to policy. Fed research shows that a large balance sheet suppresses yields at the same time you're trying to increase short-term yields. You've had QE and reverse repos operating at cross purposes. When you were doing QE, you're putting money into the economy. You had all this money flowing from the economy onto your balance sheet. So it sort of offset the hope for a stimulus, presumably. Also, now you've got the opposite effect. You are tightening QT, but the reverse repos are going down, so that you're pulling money from the economy, but it's flowing back out on the liability side into the economy. So do you feel that long-term, operating with this big balance sheet approach is really a stabilizing policy?
So let me make a distinction between the balance sheet as a policy tool, and then some of what you were talking about is the operating framework of actually hitting the Fed funds target, right? So as a policy tool, you're exactly right, right? We grew the balance sheet when we brought interest rates down to zero, right? We wanted to add more stimulus. We bought, right? We basically made the balance sheet go up. Now we're reducing the balance sheet, right? The reverse repo facility is a way that we can control, right, interest rates so that they hit our Fed funds target. So it's a mechanism of the operating framework. We've always said, right, that we kind of want that balance sheet reduction to continue and in the background. And our active tool is going to be this Fed funds rate or interest rate tool. And I think that's working the way it was intended, right? We are reducing the balance sheet, right? We're going to operate in an abundant reserves regime, but we're going to continue to reduce the balance sheet. And I think that should run regardless of what we're going to be doing with the Fed funds rate, because we can take into account any effect on the financial markets. As you say, it has an effect on term premia, and then adjust our Fed funds rate as the the active policy tool. So I think this is working the way it's intended. And I think the earlier session was exactly right. We should decouple those, right? I think Anastasia was talking about the fact that there seemed to be this, implicit, had to be that we had to, raise the funds rate before we reduce. I don't think that's true anymore. I think even the market participants understand that we can have the balance sheet reduction continue independently of what we're going to do with the funds rate.
Kathleen.
Yeah, Loretta, certainly you're somebody who's been known to be on the side of worrying about inflation, worrying about needing to do something sooner rather than later. I'm wondering about this sense that you're going to pause and see what happens. How will you gauge the time to pause? I mean, if monetary policy works with a lag, pausing and not doing enough works with a lag too. You may not see that for a while. I think, as our other guest said, the last part is the hardest. And you think it's not an accurate description in detail. Early 80s, the Fed stopped, they cut rates, they had to go back in and do even more. And I think that's a theme that's been out there as we wait to see what happens.
Well, two things. You're right. I mean, we're going to be forward looking, and we're going to look at how is the economy evolving relative to the forecast, and we have a reaction function, and we're going to do that. If the economy evolves differently than we anticipate, yes. But the thing that's different now than in the 80s and 70s is inflation expectations have basically, in the median and longer runs, remained, relatively stable. They're probably at the upper end of the range, right, that we had pre-2019, but they've been in a range consistent with price stability. And that's a huge difference in what's now than then, right? I care about inflation expectations a lot. So I look at a lot of measures of those, and we have some surveys that the Cleveland Fed does to try to gauge inflation expectations using new data. That would be the key to me, is like, are we seeing those move up, that would be an early indication, I think, that, we might have to, reevaluate but so far we haven't seen that. And the forecasts have inflation continuing to move down, but we'll have to see how the economy evolves. As I said, there's a lot of uncertainty out over there.
Inflation expectations stayed pretty well behaved, even if inflation went up very high. They never got that far up control.
No, but like year ahead, they went up, right? So again, the medium and long run are stable. You got to look at the year ahead too, and that'll help us gauge kind of where we are.
Niso, but before Niso, I have a question. You sound very resolute about the Fed's going to stick with lowering inflation to 2%. Do other FOMC members have the same resoluteness?
We are.
You don't have to speak for them,
I'm not going to
but you get the impression around the FOMC table that people are on board.
I think you should look at the chair's public statements. He was here in New York, right? And he said, right, we have a 2% goal, right? We're going to get the job done, right? And we're committed to doing it.
Great answer. Niso.
Thank you. Why does the Fed still insist on the Phillips curve? Econometrics 101, we have the missing variables problem. And what do you think are the missing variables?
I guess I would disagree with the premise that, we are so dependent on the Phillips curve. I think one thing, if you look at the research coming out of the Fed, there's been a lot of work on, is that the right model, right? I mean, different people have different models in their head, of course. So I disagree with the premise that we only look at from the perspective of the economy from the Phillips curve. I think all the models are interesting to look at, right? I think I'm a big fan of model averaging. You look at a bunch of models because not one model is necessarily going to be indicative of the current situation. But there's been a lot of new work coming out of the Fed and other central banks about predicting inflation and not necessarily using the Phillips curve as necessarily the right predictor. So I'll leave it at that.
Yes, way in the back.
Yeah, thanks for your time. I really enjoyed the presentation. Related to the earlier question about the Federal Reserve balance sheet size, right? So before COVID, I remember Fed balance sheet was below 4 trillion, and over the last, I guess, the COVID time, it bloomed to 8.4 trillion. Now it's down to 7.4 trillion. Is there any numerical target or a model-based approach or qualitative approach for the eventual kind of stabilized Fed, balance sheet, or we're just going to go on, wait and see? Thanks.
Well, there's different estimates of, where that, abundant reserves point is, and, maybe putting a little bit above that, depending on your preferences for how much you want to tolerate volatility in interest rates. We haven't stated that we have a target. We do look at a number of different statistics. As we get closer, we'll look at them more intently in terms of market functioning. Because if you remember, we brought the balance sheet down and then we ended up purchasing some because of dysfunction in the market that we've gone a little bit too far. So we have a dashboard of indicators that we're going to be looking at, that we monitor to make sure that, we're not going to go a little bit over, but there's still more runway there. I mean, we have, as you pointed out, we still have a very large balance sheet. So that can continue running over the next 2 years, year and a half, 2 years, I would imagine that, and we'd still basically be above the abundant reserves. It's going to take a while to get it down.
Yes.
Thank you. So as we look ahead to next year, how do you think about the balance of risks between beginning to ease policy back towards something more normal as a way to avoid the so-called hard landing versus the potential market reaction of undue easing of financial conditions based on that signaling of some sort of easing, even if the real policy rate were to remain somewhat stable, assuming inflation expectations come down?
I think that's going to be the communications challenge, right? I mean, it's going to be not an easy message, right, in order to navigate that. So I think it is a challenge, right? Because we have to be forward looking. We know that. If we weren't, it would be a mistake to keep raising interest rates until inflation gets to 2%. We'll way overshot, right? So it's going to be difficult, right? But I think by sort of taking the actions we've taken, right, and continuing to sort of monitor the way we've monitored, I think we have a chance of making sure that people understand our policy. That's why I've always been wanting to be very transparent and to try to communicate what our reaction function is, what our commitment is, where we see policy going, but also trying to explain that the economy could evolve differently. And if so, we might have to change our policy. That's a hard thing to communicate. Right. So I think that I do believe we can do it. Right. But I don't underestimate that there is a communications challenge there.
I've been told there's one last question. One more question.
Hi. Okay. Thank you so much for this wonderful presentation. Very quickly, climate change. We haven't said a lot about that today, but I'm just wondering, where is the Federal Reserve on that issue? Are they integrating that more into their overall policies and thoughts about the economy? I know there are some members of Congress who may oppose them for doing that. And of course, those are the people who think that we should use more fossil fuels. But I'm just wondering, where are we on that issue?
So there is work going on at various reserve banks and the Board of Governors, but tied to the Fed's mandate, right? So you can't be blind to the fact that, right, climate change could affect the economy. As you pointed out, it might affect oil markets. It can affect a lot of other parts of the economy. At the same time, it also has sort of financial stability implications to the extent that, there's risk out there and banks are taking on risk. So that's the lens that we use, right? Is it tied to the Fed's mandate, right, through its effect on the economics, the economy, and financial stability?
Okay. With that, Loretta, the Shadow Open Market Committee wants to thank you very much for your presentation and your great answers.
I really appreciate it.
And we want to thank the Manhattan Institute for sponsoring us and hosting this meeting. And stay tuned because we will be having another meeting in the spring and you will all hear about it. So once again, thank you very much. Thank you, the audience.